So without further ado, I've taken a lot of time. It's already 10:11. Now I'll invite our first speaker, Mr. Jeff Howie, market strategist of SGX, to do the sharing.
Yeah, thank you. Good morning, everybody. It's really wonderful to be here with you all and our very good friends, PhillipCapital, the quintessential relationship builders that always manage to draw a very big crowd. Good to see you, Deanna, Dollars and Cents. We're going to kick off with a quick 10-minute where I'm going to probably do a wandering walk with this. Thanks, Asmin. Damn it. Okay, so just very quick disclaimer. Obviously, the focus of today is education, particularly for my 10 minutes. And yeah, I don't have time. Sorry. Sorry. I'll stay on my lectern. Okay. So usually, I'll throw this first slide up, just reassure everybody that Singapore stock market, Straits Times Index is very well grounded with the world's strongest banks, a lot of business diversity, and significant regional revenue reach. I think most of us are familiar with this now, and we are here for trading themes and trading trends that we've seen in our market, and that's where I'll probably move to very quickly. But I guess what everything's about right now is growth. This is from my perspective. Singapore, we kicked off, this is fine. We kicked off the year expecting our growth rate to double this year. We thought interest rates would be lowered in the US in March, and we thought we'd see this global trade, manufacturing, electronics-led recovery, which has taken effect. It's just taken all effect a lot later than we thought it would happen. And because of this, and because of the size of this, we're actually expecting Singapore's GDP growth rate to actually triple this year. We actually should be up around 3% or thereabouts. We've had very strong manufacturing data in for the third quarter of this year. In fact, when you look at the industrial production, 21% year-on-year growth in August, you had electronics growth of 49% year-on-year, which is as big as we've ever seen, okay? At the same time, the trade in the US economy, I think, as we've said, it's morphed from the quantum of rate cuts to whether or not the Fed Reserve can actually pull off a very smooth landing versus that hard landing, no landing. You might have seen last night, the payrolls number was expected to come in at 150K jobs added. I think it was 250K jobs added. And yet the S&P 500 still went up. Conventional wisdom would say that, okay, if the growth is stronger than we thought, you would have maybe the markets sell off rather than post gains on the anticipation, and the quantum of those rate cuts might not be as large as we thought. Well, reason being, as I said, it's because the trade really has moved to this smooth landing. The FOMC on the 18th of September, where the Fed Reserve actually did cut rates by 50 basis points, if you watch that press conference after, that typically goes for about 45 minutes to an hour, you can see the FOMC chair, Fed chair, actually did get grilled on why he did 50 basis points on the 18th of September and not 25 basis point cut back on 31st of July and 25 basis point cut on the 18th of September. The market was a little bit concerned that the drop in the momentum of the growth of the US economy might actually be worse than we thought, and hence the chances for that soft, smooth landing, or the odds of it, were marginally reduced. So this is what we're looking at. We're looking at a very fluid, data-dependent outlook that every every, I guess, data print that actually suggests we are seeing a soft, smooth landing in the US, smooth landing, I should say, in the US economy is actually benefiting markets and inducing more interest into the investing world out here. The other thing is too what's happening in China. China reforms this year. I think Paul has said we've done a few panels before. You know, this is multi-year reform. It is still going to take a lot of time. Obviously, the property market in China not expected to recover until 2026. A lot of the reforms that have been posted this year, right from the insider of CSRC, Wu Qing, taking over the board earlier in the year, right through to the new productive quality forces doctrine, which is expected to add another trillion renminbi to output. You know, in terms of the domestic demand around 1 trillion renminbi, and then a couple more trillion renminbi on the output that comes from the recycling of consumer durables and automobiles. And then, of course, you had the measures most recently, the week before last, which kicked off with the new main policy rate of the 7-day reverse repo rate being reduced from 1.7 to 1.5%. And the MLF was also reduced. And you also had financial sector and banking reforms as well, which are expected to add another 2 trillion renminbi of stimulus into the China economy. How does that all add up? Well, the GDP in China is around somewhere between 120 trillion and 130 trillion renminbi. So these moves have not been insignificant, which has induced a big bout of short covering. And then obviously we've seen a little bit of consolidation around those gains this week. So it still remains to be seen where we go from here. But we do have obviously a very fluid outlook, big moving markets, obviously having some form of synchronous monetary policy expansion or stimulus in the world's two largest economies does obviously help. And at the same time, you still have the tensions in the Middle East as well as Eastern Europe. And that's why we're having gold. Our gold ETF trading around $2,650 an ounce is the underlying price. And I think early 2025, the street have a consensus estimate that could rise up to $2,900. All the while, our STI has been super competitive. The returns since the end of 2019, right through COVID, through to the end of the third quarter of this year, you can see in US dollar terms, it's 44%, which outpaces FTSE APAC indices and also outpaces our region across ASEAN. But as you can see in that little grey shaded bars for the third quarter, ASEAN was very strong, and this really helped Singapore rebound as well. And it also added an element of sustainability in the recent gains of the STI. So now we're around, where are we? Near that 3,600 mark, thereabouts, 3,650. The all-time high on the STI was 3,906 in October 2007. So we're still a little ways off there. But a couple of differences. Back then, the day before we actually made the all-time high for the STI, our GDP growth print for the third quarter in Singapore was actually up 9.4% year on year, which is very, very strong. Your valuations were also stretched. The price to book ratio for the STI was also 2.5 times thereabouts. At the moment, we're close to 1.2 times, 1.3 times, which is pretty much our 10-year average in terms of our price to book ratio. What retail investors have been doing during this rally that we've seen in the third quarter of 18% on the STI is actually selling into the rally. Retail investors net bought Singapore stocks to the amount of 1 billion Singapore dollars in the first half of this year. And then in the third quarter of this year, have reversed that with net selling of $1 billion. As an example, Keppel DC REIT We saw 45 million Singapore dollars of net buying in Capital DC REIT in the first half of the year. The volume weighted average price per unit was $1.74. And then you saw that reversed with 50 million of net selling by retail investors with a much higher VWAP of $2.05. I'll come back to that slide. I just wanted to go to this slide right away because it also shows you that what retail investors have been buying and selling this year in particular, which sector is actually in the spotlight. It's not actually the banks, it's not the REITs, but it's been the maritime, the offshore support vessel and energy sector. In fact, when you look at the first half, right, you can see Nam Cheong, which is formed in 1968 in Malaysia, building fishing vessels. Now they have one of the biggest shipbuilding docks in Malaysia. And you can see that stock, you had a 62% decline in the stock in the first half of the year. And retail here net bought 5% of the value of that stock in the first half of this year. And then coming down to the second half of the year, sorry, not sure what the pointer. Yeah, okay. Coming to the second half of the year, you can see Nam Cheong is here. And it's actually risen 179% since it reported its very strong net profit, which soared in the first half of the year on the back of many debt waivers. So that rose 179%. And you can see net retail actually sold 2%, as much as 2% of the value of the stock. They sold 3 million Singapore dollars as in net after buying, how much did we say? $9 million in net in the first half. Seatrium as well has been, it was the STI strongest stock this week, up 15%. And you can see in the first half of this year, the stock price and the net total return of the stock was down 42%, but retail actually were significant net buyers. They bought 5% of the stock. And then in the third quarter, retail had been selling close to half of that net buying as the stock rallied 28% in the third quarter. And the interesting thing too is when you look at the stocks that retail have actually been net buying in the third quarter, 7 of these stocks here are the same 7 stocks here that retail were net selling in the first half of this year. So these universe of stocks here, it's taken from the 100 most traded stocks in Singapore on a day-to-day basis, so the bulk of the trading activity. And you can see that Beng Quang Marine, for instance, when it rallied 260% in the first half of this year, retail actually, their net selling was as much as 10% of the value of the stock. And then in the third quarter, you can see that net selling has been 5% of the value of the stock, while the stock has consolidated on those gains. So Franken is tech, but Beng Quang, Marco Polo Marine, Mermaid Maritime, Yangtze Shipbuilding, Samadura Shipping, Dynamac, Geoenergy Resources all come under that sector of maritime offshore support vessels as well as energy. So I just want to draw your attention to this because I think this is pretty interesting to show exactly what retail have been net buying, net selling. You can see there's more net selling in strength, more net buying in weakness, and this is the sector that has particularly been in play. PhillipCapital has also initiated coverage on one of these stocks that is just outside the 100 most traded, but it has also been moving quite a bit this year, Pacific Radiance. So do make sure you have a read of that report. And just a final, just to show the variability that we do have, if you do want to take that trading lens to our stock market. Over the last 4 quarters, there's not many stocks that go into this. You've basically got your IHS REIT index, your manufacturing index here in Singapore, as we said, 100 stocks, pretty much mirrors the clusters of Singapore's industrial production. Your 3 telcos, StarHub, Singtel, Netlink, NBN Trust. This is just simply average total returns for the quarter. And then for the travel hospitality, it's a really simple arc of just Singapore Airlines, Comfort Delgro, as well as Genting Singapore, and the trio banks. And you can see with sector rotation, had you invested in the best performing segments of these simple small part of our market, you would have generated returns of around 40%. And had you invested in the worst performing segment, you would have generated returns around 5%. So within the stock market, obviously, you have the long-term structural themes of digitalization and sustainable shifts, which is really impacting many stocks in the way they become more operationally efficient. But you do have very fluid outlooks, not just in terms of monetary policy, but also the world making strategic shifts back to industrial policy, funded more by fiscal policy. And because of this, because the macro forces are getting a little bit more interesting, I think it means we're going to have a lot more dynamic market movements, possibly more sector variation, and hence why I have taken just this quick 10, 15 minutes to cover some of those segments that are currently in play in the market, as well as just drawing your attention to some of the broader moves by all the different sectors. So I'll finish off right now. And if you want to read a little bit more about all these different stocks and sectors, please do scan the QR code. And I will move on. And Paul, I think, is next. Yep, brilliant. There you go.
Right, thanks, Jeff Howie, on his insightful sharing on the market trends. So next one will be on the market research team, where Paul and his team will then start sharing regarding the Singapore market.
So thanks everyone for attending on the Saturday morning. Apologize, especially grateful for those that are able to come from Jurong East and Buona Vista. Also, sorry for the long queue for some of you. Someone asked me, was this the High Court? I said, no, it's the SGX event. Okay, so for today, we're just going to run through our strategy for the 4th quarter. In general, what we're saying is that when rates fall, because since September, based on my count, there's almost 17 central banks that have cut interest rates. Of course, if you want to do number of cuts, could be like 26 because you use a 50 basis. But in general, I think more than around 17 central banks have cut. We still think interest rates cuts will continue, and that will be the key theme. My name is Paul Chee, research. Sorry, my whole analyst team is here, so each of us will just run through their respective sectors. Disclaimer, nobody reads, neither do I, but let me just summarize it for you. This is for education. No, we rely on public information, we can't verify, and we may change our views. General speculation and may not meet your investment objectives, and feel free to seek advice from your financial advisor if this is applicable for you. We'll run through very quickly overview of what happened in the 3rd quarter, macro driver. Again, the macro driver is mainly just to give you a sense of the macro backdrop. Of course, forecasting macro is a nightmare, it's a graveyard to do it. But again, just for you to give a sense, we will talk about investment teams. What we have is what we think there's short-term momentum. Some stocks we think has some short-term momentum, and some that have medium-term. We'll just have a quick snapshot of the model portfolio, and we have some closing remarks. And of course, and some of our comments on what we think of the XGX review, because I think a lot of people are going to ask us that too. Okay, so anyway, for the 3rd quarter, as the table suggests, it was a milestone in 23rd September. We hit a 17-year high. Some people were happy, but of course, it also means that after 17 years, nothing happened. But if you are buy and hold, at least you can be gratified now that it's working after 17 years. So my colleague Zain did our technical analyst. He just did a snapshot since the record high that we had like 3-1. What were the stocks that dragged? So on the left were those that did well, of course the banks, and then on the right of course those that didn't do so well. So we can see the derating in property, Wilma, but I think Wilma should rebound strongly. But and then we have also airlines. Again, this is just for your own understanding. Of course, some of these stocks were before, just listed after 2007, those in asterisks. But again, just in for, and also just a reminder that that's why dividend is so important. If you're going to have 17 years of patience, you need at least some dividends to fend off that patience. Okay, then in terms of what happened in the third quarter, banks were up almost 19%, DBS especially up 30%. You add in the dividends, you're up almost 40%. Banks have been up almost every quarter. Then on your right will be cyclical. So these were the ones that bounced up. Citrum. Although if you look at the prior chart, sorry to flick back, it was down 90%. It was up yesterday, so probably it's only down like 89 maybe. So, but in general, these were the stocks that moved in the quarter. SIA was down, venture. We think REITs bounced very well. It was a spectacular bounce for REITs. Even though the big bounce, they were actually still down for the year. We think there could be a mild sell-off in REITs because of what happened on Friday. Because I think if you look at the interest rates, they actually were up. I think you can actually, some of you can sit in front of you if you wish. Yeah, yeah. As you can see, the interest rates, I think Treasury bond yields were up almost 30 basis points in one day. So we think there could be some weakness coming up for REITs and so on. Okay, just last two slides. So if you want to look at what assets have done well, so REITs again has been a spectacular run, up 20% in just 3 months, and the best for the year in blue has been gold and commodities, and even bonds did better than the Nasdaq in the third quarter. But I think because of the cuts in interest rates, that's why it's so important. The interest rates have such a meaningful impact. Just one last one. So this is just in local currency. Hong Kong did exceptionally well. We all know that in 1 month it just went up 17%. We'll have a quick chart on China later, and then REITs. But the one that's underperformed has been the tech names. So South Korea, Japan. So these are the tech that has underperformed for the third quarter. Again, not much value this, but again, just to give everyone a sense of what has happened. But nobody cares, so everyone wants to look at the outlook. So we think things will be slower. Economic conditions, we think will still be slower, but it's not tipping over. Tipping over means not tipping over into a recession. One of the things we look, of course, we always have to look at the US. So if you look at the US, consumption is 70% of GDP. And of course, so retail sales is an important thing that we look at. And retail sales, the blue line shows that it's just moving sideways. But one interesting part is that the inventory is starting to build. So what we think is that the inventory build-up that's happening is also supporting the export sector, because ahead of the elections and ahead of possible trade tariffs, I think the retailers are stocking up. That's why you see this red line starting to bump up, and that's why you see, I think our export sector, not only in Singapore, Taiwan, Korea, they're all doing well. We think there's a bit of front loading of inventory, and that is helping our export sector. The next slide is, of course, jobs. What worries us is the red line. So the red line is the economic sensitive jobs, like private sector jobs. So that continues to trend. Last month, I mean, the number that we had on Friday was exceptionally good. And the most bullish way to interpret the number is productivity gains. So what it means is that we have a lot of jobs, but inflation didn't go up. So what it means that if you're an economist, we don't have, so I'm the only one. So what it also means that productivity is good, so it actually will raise profitability and so forth. So that's the best case scenario, we hope. So next week you will know, because next week will be the US inflation number, and if that is if that number is benign or soft, then it will be a very bullish case again for the US equities, because you have your cake and you can eat it. I mean, like high growth but no inflation. It's like eating cake and you can lose a bit. The other thing is, okay, so for China, before the stimulus, we still think that it will be weak. Why we say so is that, I mean, we do speak to some Chinese developers. So if you look at the blue line, the concern is the blue line. Blue line means the space completed. That means the amount of houses constructed. So the last 2 years, of course, developers bought a lot of land, then they built, and then nobody bought. So, but they still managed to get, speaking to some developers, they still managed to get financing. So they're still able to complete the projects, mostly by next year or end of next year, most of the jobs will be done. But once it's done, the problem is there won't be any more work So without any more work, it's going to affect demand for building cement, demand for steel, demand for furniture. Now, after you've complete, you want to buy furniture, electrical fittings, and you can, and renovation, since there's no neighbors anyway, since so many unsold units. But what it does mean is that economic activity, we worry, was slow because most of the units are completed, no one's buying more land. And what it also implies is that the migrant, because in the major cities, usually it's a migrant workforce. So the other worry that investors have is that what happens to this workforce if there's no jobs? Again, up to everyone to imagine. Not for me to say, but that's the worry, that next year it could be even slower. The new stimulus measures that we had in China, these are not my words, but only if you are a CCP, you can mention things like powerful lowering. So these are the key things. So usually their so-called government, the central government meets in April, May, and in December. But September was like an emergency meeting. So basically they said they're going to spend fiscally, they're going to raise bonds, they're going to powerful, I'm not sure who came out with this word, but it's according to the Xinhua press. So they're going to lower interest rates aggressively, and they are also going to stabilize the real estate, but not build new homes. And most important, they want to guide market. I underline this because because we are doing a SGX review, right? So even the communists, the Chinese Communist Party understands the importance of the stock market. So I underline this in case anyone's watching. So vigorously guide money into the stock market. But what is the impact? So for us, the impact on the economy might be slower because it will be through the wealth effect. That means everyone get rich. But it only happened 1 week ago, so it may not have the big impact on the economy in China yet. But again, wealth is one thing. You still need to have jobs, you still need to have income, and that only can happen if there are handouts and fiscal spending, which is important. So the market is watching for this. We still think China could run after the Golden Week because you'll probably get some numbers out of the Golden Week, and everything will be bullish. If the number is big, then the market will just say, oh, the stimulus hasn't happened. And if the number is strong, then everyone will just say, oh, I told you the stimulus is happening. So regardless, I think you could have one more run. But we just worry as the elections come, then the risk off will happen. From financial, you get a lot of flows right now. It may not be reflective of why investors believe China will turn around. But if you're a fund manager, China used to be underweight, uninvestable, don't look at it, to now career risk. If you don't have China, you might lose your job. So everyone will just buy China. So it may not be reflective of the fundamentals, but again, you don't want to stand in front of flows. The next part is Japan. This one, nothing much to say, just grinding sideways. I think every year it just be like that, just moving nowhere, I guess. Okay, in terms of interest rates, so what we think, if you look on your far left, that's what the Fed is their base case. So what we think is there will be at least 2 rate cuts coming up this year, November, December, and there could be 4 more coming up in 2025. Of course, the market thought that in November there'll be 50 basis points or 0.5%, but I think right now you're looking at maybe 0.25. So even Powell has said the dot plots, use that as your base case. Although everyone says dot plots is no use, these are basically the Federal Reserve's projections. But anyway, the key message here is that interest rates will continue to come down. The pace is never clear. One of the reasons is that inflation is trending down. If you look at the red line, it's trending down towards the green line, which is the objective. So the shaded part is the forecast. I won't run through all this too much because macro, I think, might bore everyone. This is, if you're some economists, why they have room to cut rates. So if you look on the red line on your left, the real rate, because how much is too much. So in the past, the red line was even below 0, the real interest rates. I won't run through this, and I will just move on. So, but the problem we have is that if you look at this confusing chart, the red line is when the Fed cut rates, usually it coincides, very bad timing, it coincides with a recession, the shaded part. So it doesn't mean that every time the Fed cut rates, the market will rally because it tends to coincide with a recession. Not all the time. If you look at 1994, you notice the red line came down, but the market still rallied. But of course, again, this is only a sample size of 4, and you can't say number 4. You look at number 4, COVID, and the Fed. You can't say that the Fed cut rates and then because COVID then caused COVID, right? So sometimes it doesn't really make sense. But again, it's just the market is still concerned about recession because rate cuts have always been preempted by recession. But again, for this time, we don't see any particular risk, especially with the jobs data coming up. I'll move on to Singapore. Singapore, we still think will be generally stable. We have a big export bump here. So if you look at the red line, electronics has bumped up and so forth. We think again there's a big restocking in Singapore. If you look at hospitality, that has been doing very well. I think if you look at China especially, so China numbers arrivals into Singapore now is about 400,000. This is a record high, higher than even pre-pandemic. They are growing, so Chinatown is still going to be very crowded. And this is even before Golden Week. So the numbers are still, so this is positive for Singapore because tourism is one of the key growth areas for us. And there will also be many more events coming up next year. So tourism continues to grow. The worry was that after this pre-pandemic bump, it would start to slow. So China is the one, I think the numbers are up almost 90% year on year. Construction is of course the hot sector in Singapore right now because of the blue line. So blue line means contracts awarded, and based on the PCA forecast, you will probably looking at 39 billion a year on average. In the past, construction is always hard to buy into the construction sector because 1 year good, 1 year bad, like riding a road. It's like on the rodeo. But this time round, I think it'll be more stable. And this is even before Terminal 5, and this is even before the 2 integrated resorts. Each one spending maybe 7-8 billion per casino. So it's going to be strong for the next 2 years. For us, we play it through building materials like Pan United, we play it through BRC or even Centurion, which my colleague just initiated. Population, nothing much. I think this is just let's pop it up there now. So, but what the key thing is that population is growing at 2% compared to pre-pandemic, and for GDP purposes, it's good. I mean, just so that it's good for retail spending, it's good for property purchase and so forth. Last one for Singapore valuations is, even though it's gone up, it's still at the lower quartile. It's still like 12 times compared to average of 14. Even our dividend yield, you are looking at 5.5% for the market. You take it, you adjust it for the bond yields. That means you can, should you put money in FD or put in dividend in the stock market, you can still see that it's about 2.6% above interest rates. Last one, US president elections is probably the most important for the next 1 month. So we are worried. I think we worry because we think the market might de-risk before the election, maybe 1-2 weeks, because you're not sure. Because if you have Trump, there might be a global trade war because if he imposed tariffs, and then for Kamala. At least I pronounced it correctly. For Kamala, it will be risk of higher corporate tax and also capital gains tax. The best case scenario, I mean, not as a political observer, but the best case scenario from the market point of view is status quo. That means we have Kamala, a Democrat president, and the lower house Senate all controlled by Republicans. So so there is like a deadlock type of kind of government. A hung government, I lack of a better word. So that's the best case scenario. Again, this is from the market's perspective. But we worry they more de-risk. And even after the elections, there's also some worry, especially if you watch the movie Civil War. You also worry whether after the elections, whether the whoever loses will accept it. So there's also this kind of worry that the market may have or may not have. I do not know, but I think you probably could see some de-risking maybe 2 weeks before and 1 week after. Of course, if you take a contrary view, if the market comes down, it will be a good time to buy. But I think market investors will probably stay on the sidelines. I'll hand it over to Zain. He'll just give some stock picks from the technical, and then we'll move on to stocks and sectors and so forth. I'll hand it over to Zain. Yeah, thanks.
Yeah, good morning, everyone. Thanks, Paul. I'm Zain, the technical analyst. So I'll be going through the outlook of the Singapore market, our large cap pick as well as mid cap pick from the lens of technical analysis. So first up, Singapore market. So this is the chart of the ES3 ETF, which is the STI ETF. It's showing a strong bullish momentum. We had a very commendable third quarter. It was up about 9.7%. So in terms of our fourth quarter target, we are looking at 3.8, which is about 4.3% upside from current levels. Looking at the chart, momentum is still very strong. Price is still trading above the main uptrend channel, also holding above the upward support line. Recently, we also saw price broke above 350 resistance level as well. So we still see room for more upside in fourth quarter for Singapore market ETF. Then next up for large cap pick, we are looking at city developments. So for city developments, there's a signs of a potential bullish reversal in the making. So first up, looking at the chart, price has formed inverse head and shoulders formation, which is typically a bullish reversal signal. So the neckline to look out for is the $5.55 level, where if price can break out above that, which is confluent with a downtrend resistance line, we could see price potentially moving higher towards $6.08 level, which is confirmed with our previous horizontal resistance. So potential upside from current levels is about 11.3%. Yeah, if price can break above these levels. Then last but not least, for mid-cap pick, we are looking at Food Empire. So for Food Empire, similarly, we see a potential bullish reversal ahead. Looking at our chart, price has been trending downwards since February, March this year, but we see some signs of the stock basing out recently, especially in July to October. Price has formed a sideways trading range. Support has held at 96 cents. Recently, price has also broke above the $1.01 range consolidation resistance. This came after a breakout of the downwards resistance line earlier. So we see that the stock could potentially rally higher from current levels towards potentially $1.15, the previous horizontal resistance in middle of this year in May. So that represents about 11.6% upside from potential levels, from current levels, sorry. Yeah, so that's all from me. I'll hand over time to Glenn to get us started on our investment teams.
Hey, thanks, Zane. Yep. So I'll be starting firstly with the favorite sector for Singaporeans and Singapore in general, and that's the banking sector. So moving on to the next slide. Yep. So we just do a quick review of the second quarter results. Looking at the results, look at the top two figures there. That's the net interest margins, net interest income. It's roughly within expectations because we know we are expecting this to sort of flatten or even have a slow decline. And it's if you can see, it's like a mid-single digit sort of decline. However, you can see that the net interest income surprisingly was still, if you look at the average, it's positive. I'll go more into that later. But what was the main growth driver for their second quarter results for the banks? That would be the net fees and commissions. So fee income, wealth management income. And across the board, we can see average is around double-digit growth for the banks. And they're also expecting it to continue into the rest of the year. General provisions are also quite subdued, is I guess back to lower than pre-COVID levels. It's quite flat and it's not expected to be increased. For the PATMI, we can see that because of the fee income, we can see that the PATMI has actually grown quite healthily. I think the biggest outlier here, if you look in the middle, there's OCBC. It's up, the second quarter was up 14% year on year. And this is mainly due to their insurance arm actually growing by double digits. So this is even before they have fully acquired GE. So there's a possibility that going into the future when they finally finalize that acquisition, it could have more synergies and this could be even better for them. CET1 is also still above their, you look at the bottom line here, CET1 is still above their optimal operating range of around 12.5% to 13.5%. So there is some possibility here that we might see higher dividends or a higher dividend payout ratio. But I think for the two banks like OCBC and UOB, they're quite strict and they have said that no, we are only going to give you a 50% dividend payout ratio. So maybe only for DBS for that. Okay, now we're going into the net interest income and net interest margins. I said I'll explain this a little bit further. This is a bit confusing, this chart here, but it's basically just charting out the Singapore interest rates. We are using the 3-month SORA against the bank's net interest margins. So the net interest margins do follow the NIMs quite a bit. The net interest margins do follow the interest rates quite a bit. As we all know, when the interest rates go up, the banks benefit quite a lot from it. We have seen that after COVID where the interest rates were hiked and the banks were suddenly flush with net interest income from this, the blue bar here, you can see, and the NIMs also went up quite a bit. However, the biggest worry, I guess, for the banks, and I think the questions that you all have and I get quite often is what will happen to the banks once interest rates drop? And we have seen the interest rates have started to drop. So we do still feel that while yes, there would be a sort of a slow, subtle decline in their net interest margins, but Singapore banks are quite well protected in a sense that, you know, the one way they make their net interest margins and net interest income from is the way that everyone knows, by giving out loans and then they earn that margin. But another way, which they don't really publicize as much, is by taking excess deposits, customer deposits that they have, and then putting it into sort of longer tenure interest earning assets. So this can be securities, you know, or deposits elsewhere that earn higher interest. So what the banks have done recently to protect their NIMs would be to put these more of their excess deposits, instead of lending it out, they will put it more into these interest earning assets. And that's how they are able to sort of protect their NIMs for maybe up to the first half of next year. So we are quite confident in saying, if you look at let me try to find the pointer. Sorry, if you look at this year, we are expecting that for this year end, you know, NIMs will only dip by 3 basis points, and for next year, it will also be relatively flat, maybe dropping by around 8 basis points. But the net interest income should still remain relatively flat. And then going into the next question is, you should be asking, or I should be asking myself as well, is like, so what is the growth driver for banks? Is there no more upside? But we do feel that there's 3 factors that we're looking at that will help the banks continue to drive their earnings and will provide the boost for their earnings. Yep, the first one, being the largest one, would be that their fee income is structurally driving their earnings. So what we have seen in the last few quarters or even the last few years is that the bank's AUM, or assets under management, has been growing healthily. You can see from this blue chart here, it's been growing very healthily. But what we could not see is that why wasn't their fee income also growing in tandem with the AUM growth? Because it makes sense, right? If you have a larger base, means that the fees you should get is as well, it should grow. But you know, it's quite staggered, you know, it's like all over the place. I think the main reason for that is that during the high interest rate environment, a lot of the customers, instead of putting into investment products, they are putting it into fixed deposits, right? So this earns very little margins for the banks. And that is what they were experiencing, you know, during this period here in the center here, right? It actually dipped. AUM went up, but fee income dipped. Right? It's because of this scenario where they put it into fixed deposits. However, now we are getting more of a risk-on sentiment because rates are dropping. So customers and their investors are putting it more into investment products. And these investment products help the bank earn a higher margin. So while AUM growth is still continuing to grow, it's doubled by having a higher margins on how much the AUM that they have. Hence, we still do expect, you know, this jump here, it will continue to jump up as double-digit growth for the rest of the year and going into next year as well. So that is the first growth driver for the banks. Secondly, we are also expecting that a trading income surge could be possible. It's a bit of a confusing chart you see here, but the orange line is the VIX, which is the volatility index that we use to measure volatility. If you look at the big spike up there, right, that was during the COVID period, hence there was a very large jump. It's not exactly following, but we do expect that, you know, if you look at the last bit here, all the way at the corner on the right side, you can see that there was a bit of a jump, right? This was, I think, the third quarter. So there could be a possibility that trading income could also follow this, and you could further increase for the banks. And the last point for the banks, and I guess this one would be also quite a big segment for them, would be the loan growth recovery, which has actually started even though rates have not gone down. So we have the data until August, right? August rates were not really cut yet, but we can see August and July. This is from MES, the data, the statistics. Loans growth was actually at around 2%, just below 2%. And although interest rates were still very high, but we can see that loans have grown at this low single digit. The banks are guiding for low single digit. However, we feel that there's a possibility they could exceed this, and we could even see a mid single digit when the interest rates are cut even further, or we finally feel the cut of the interest rates. For the loans growth sector, housing loans have been quite strong in Singapore, but we still feel that the business loans, there's a possibility that it could continue to grow going into the rest of the year when more of the rate cuts are felt by the whole sector. So those are the 3 points for the banking sector. Now I'll go into our stock pick. So our stock pick would be UOB. right? Our title is that it benefits the most from the rate cuts. So whatever I said earlier applies, it sort of applies to all three local banks, right? DBS, UOB, and OCBC. But why do we prefer UOB? It's not that DBS and OCBC are laggards, right? But that UOB has certain factors that make them different from the other two. Firstly, they have a very high proportion of their CASA and fixed deposits. A lot of it is into fixed deposits, and also historically they have been the first to increase their fixed deposit rates. Right, a lot of customers go to UOB because their FD rates were the highest at that point of time. But then they were also the first to cut it. Same with their CASA as well, their UOB One account. So they were also the first to cut it. So we do feel that there's more room to go. If you look at this, they are currently around 40-something%, right? And that we feel that it could drop even further. And that's where their cost of funds will improve, and that will benefit their net interest margins for UOB. And secondly, we also feel that UOB has the smallest presence in Greater China, so China and Hong Kong. Yeah, the rest have around 20% of their portfolio, which is in China and Hong Kong. But UOB, I think, is less than, it's 5 to 10%. Yeah, that's the range. So they, with that sector not doing as well, so we feel that UOB is more protected in that sense. And the last point for UOB is that they are also trying to move away from the traditional way of banking where they're just giving out loans to SMEs. And now they're trying to push towards more heavily into fee income, wealth management, trading income. Yeah, I think their goal by 2026 is to be around 36 to 39% of that, of their income coming from the wealth management sector. And also they are trying to expand out of Singapore. They realize that Singapore is a bit of a saturated market. So that's why they've made the acquisition with Citibank. And so they're going to their, what they call the ASEAN 4, which is like Malaysia, Thailand, Vietnam, Indonesia. Yep. So those are the factors we feel that why we prefer UOB over the other two banks. We do have an accumulate call as well as a target price of $34.90. So that's all I have for the banking sector. I'll now hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so I'm Darren. I cover the REITs. So I'll just talk more about REITs here. So this chart, obviously this graph, it just shows the first half performance of most of the REITs. So we see here, like CICT is a FEHT and Maple Tree Industrial were the only three REITs in this table that managed to generate DPU growth. So that is mainly because of the higher interest expense, where even if the NPI of the REITs, they managed to increase. Like for instance, CapitaLand and Scott Trust, NPI up by 12%, but the DPU is still down. That's mainly because of higher interest expense. And for CapitaLand and Scott Trust specifically, they did a fundraising last year in third quarter. So that's also why the DPU fell. But while moving towards the bottom end of this chart here, we see like Suntec REIT is down by 12.5%, Elite is down by 90.5%. So Elite is down so much, that's mainly because of the EFR that was done, equity fundraising, as well as a 40% jump in interest expense. So for Lendlease Global, it is down 21%. That's mainly because of also interest expense. It jumped by about 27%. So for Prime US REIT, that's a different story totally. So that is because, first of all, NPI is down 14% because of weaker occupancy. And the DPU is down because they only paid 10% of their distributions because they have to keep some capital for their capex. And that is even better than the other two US REIT peers where they are not even paying any distributions. So on the right side, the green bar, so-called the green chart there, so that is a faded graph where it shows the percentage of loan fixed. So 35% is Far East Hospitality Trust. Their percentage of loans fixed are the lowest in this chart. So it's faded all the way until 81%. So this just shows going forward how the REITs can benefit from lower interest rates. So basically how REITs benefit from lower interest rates are these four reasons. So one of it is definitely lower interest expense, where with lower interest expense, basically the distribution that they pay out will not be eroded as much as before when interest rates were high. So that is one reason. Another reason is because of with lower interest rates, basically cap rates will start to compress. So in the previous few years, we saw cap rates expand because of the increasing interest rates. So that really affected property valuations. We saw property valuations increase by quite a lot, significantly over the past couple of years, especially the US REITs where we saw the property valuations decrease by, basically valuations were hit because of the expanding cap rates. So that is two reasons. The third reason is with lower interest rates, we expect the property transaction market to improve. So in September alone, we already saw 4 significant transactions. So one of it was Manulife, and another 2 was with CapitaLand. The divestment from CapitaLand of Ion to CICT, as well as the most recent one, the divestment of Life Funan to Class, as well as the last one was Manulife's divestment. So we saw transaction volume really pick up. And the last one is basically the dividend yield spread. We expect it to increase with lower interest rates. So I have a slide on dividend yield spread later. So we did some sensitivity analysis as well. So based on the fact that some of these REITs have already a high percentage of loans fixed, so every 100 basis points decrease in interest rates will likely on average increase DPU, the REITs DPU by about 5%. So of course, the overseas US REITs like with lower hedge percentage will benefit more, while like those who have a high rate, high percentage of loan fixed, like for example, CapitaLand, Ascendas REIT, 83%, they only have a small impact to DPU if interest rates fall. So maybe about 2%. So on average, it's about a 5% increase. Yeah, so next we have this chart. So this chart, it shows basically the REIT index performance over the past 20 years and how it correlates with the Fed funds rate. So we see here, like at this point in time where the rates were peaked at about 5% in the previous cycle, that was during the GFC, we saw REITs manage to rally for some reason. We think this was probably because it was kind of in a bubble territory as well. And when the rates were cut here, we saw the REITs crash. So that's mainly because of the recession. So a similar thing happened in 2020 as well, where rates peaked around here. We saw the potential for a little bit of rally. We saw the REITs rally a little bit as well, and then eventually kind of crashed as well when the rates were cut. So I tabulated a table here. So this table shows September 07. So this date was the date where the first rate cut was done in the cycle, and the next date here, December 08, was the last rate cut in the cycle. Yeah, so we see that one year after the first rate cut in the cycle, we saw that REITs were also generally they outperformed. So it happened both times as well in July as well. So 1 year after the first cut, it was down 40%, and 2020 it was down 7% plus. But 1 year after the last rate cut in the cycle, we see REITs managed to rally 67% in the 2008 period and 15%, 14.46% in 2020. Yeah. So going forward, we think because basically we see that rates have peaked over the past 2 years, but we saw the REITs share price didn't really rally. So we think that the REITs have already priced in a lower interest expense, or rather a higher interest expense back then. And going forward, we think with lower interest expense upcoming, we think REITs there is a potential to rally. Yeah, so that's different from the past where even though rates peaked, we saw the REITs still rally. So we think it's because they didn't really factor in the fact that the interest rates were going to affect DPU. Yeah, so the next slide I have here is the S-REITs index price to NAV. So we see even though over the past 2.5 months, REITs managed to rally about 10%, we see the price to NAV is still trading slightly above COVID-19 lows, and it's trading about -1 time standard deviation from the mean. So it's now about 0.92 times. So that is still cheap in our opinion, and we think there's still more room for REITs to recover back towards its historical mean of about 1.03 times. And lastly, this is the dividend yield spread that I was talking about. So first of all, the shaded background we see here, that's the forward dividend yield. So REITs recently they managed to rally, so that was why the forward dividend yield has fallen a little bit. So it's fallen to about the 6% mark. But going forward, we expect the absolute number of DPU, or rather the distributions, to increase. And assuming if the share price remains constant, so the forward dividend yield spread that will definitely increase. So the dividend yield spread, so this is the bottom line chart here. So that basically is the forward dividend yield of the REITs minus the 10-year Singapore government savings bond yield, or risk-free rate as a proxy. So that means, for instance, like your fixed deposit rate is paying you a 2% interest rate. And if the REITs dividend yield is 5%, so that means the dividend yield spread is 3%. So basically that means 5 minus 2. So going forward with interest rate cuts, we expect the 10-year government savings bonds to the yield to decrease further, and with the increase in dividend yield for the REITs, we expect this dividend yield spread to keep increasing over the next few quarters. So we think REITs will start to look more attractive. And yeah, so now we move on to more of our stock picks. So for our REIT pick, one of our top REIT picks is Cromwell European REIT. So Cromwell European REIT is a very diversified REIT, logistics, light industrial space in Europe as well as office. So it has about 110 properties. And why we like them is because they are paying a very high dividend yield of 8.5% despite the decline in DPU. So let me explain why we are forecasting some DPU decline. That's mainly because back then when interest rates were increasing, cap rates were also increasing, that really affected the property valuation. So property valuations were decreasing. So as a result of that, the REITs, they all have to maintain a gearing of below 45%, or back then it's 50% if the ICR, interest coverage ratio, is 2.5 times. So they want to keep it below that. For Cromwell, they specifically, they want to keep it below 40%. So because of that, they've been divesting assets, trying to use the proceeds to pay off some of the loans and to keep basically keep gearing below 40%. So when they divest assets, what will happen is fewer assets will start contributing to their top line, and as a result, the DPU will decrease. So we've already factored in the fact that they've divested 200 over million euro of properties. So even though we factored that in, we still see DPU be about 14 cents for this year, and next year it will drop to about 13.16 cents as they refinance one of their bonds. The bonds were taken on when basically the Eurozone rates was negative. So when they refinance, there'll be a bit step up in interest rates for them. But even at 13.16%, they are still paying about an 8.5% yield at the current share price. So we think that is very resilient for them. And basically for Cromwell European REIT, they managed to survive COVID, a war in Europe also, and also higher interest rates. So we think they're really very resilient. And next, we have CLI as one of our top picks as well, but CLI is not a REIT, it's more like the mother and father of the REITs. So for CLI, they have a target to, rather their business strategy is, they have FUM, so that's a funds under management, and their FRB, their fee-related business, as well as their REIB, which is the real estate investment business. So for them, they have a target to increase their FRB, the proportion of EBITDA that is contributed from FRB to it's been increasing over the past few quarters, and they also want to increase it further. So that is the FRE business is basically from the listed platforms. They collect management fee from the listed REITs, from the private funds as well as management fees from the lodging units as well as the commercial properties. So that's the FRB. And for the REIB, basically is their ownership stake in the REITs, as well as the ownership stake in their balance sheet assets where they collect income. So going forward, they have showed that they managed to divest some of their balance sheet assets like from China, as well as like ION. They also divested into one of the REITs platform. So basically they're transforming their REIB assets into their FUM, the funds under management. So that will increase basically the fees that they can earn. So going forward, they are targeting about 10% fee increment every year, year-on-year growth in FRB. So also because of lower interest rates will definitely benefit them because of the transactions volume. With cheaper funds, more transactions will happen, and basically CLI will earn more event-driven fees. So event-driven fees on a normalized basis will be about double or 2 times of what it is currently, because over the past few quarters, there were not many transactions. And like I mentioned, just in the last quarter, we saw CLI already had 2 major transactions. So one of it is ION, as well as another divestment to Class, like I mentioned earlier. Yeah, so that is why we really like CLI. And yeah, so that's all for me. And I'll hand over time to Mariam to talk more about some of the REITs. Yeah, thanks.
Thank you, Darren. Hi, I'm Mel, research analyst. I'll go through some of the REITs stock picks. So we like OYE REIT mainly because of its very attractive valuation. They just obtained investment grade rating earlier this year, and they refinanced some of its debt at a historically low rate of 0.9%. So here's a table to compare some of the metrics. Among the 9 investment grade REITs in Singapore, OYE REIT has relatively healthy gearing of 38.7%, and also is trading at very attractive dividend yield of 5.8%, which is above the average. And most importantly, is the most heavily discounted investment grade REITs in Singapore. It's trading at more than 50% discount to its net asset value. And that is very much below the average S rate. And also even below historically, they were trading at 0.8 times price to NAV, with over 90% of the income generated from the AA rated Singapore sector. And over 70% of the income is generated from the retail and office sector. And in first half 24, they managed to secure 11.8% and 28.4% respectively in terms of rental reversion for its office and retail sector. And we believe the trend is able to sustain in the second half 24. And we do expect upside to come from the hospitality sector, although ADR has shown slight moderation in Singapore, but we believe occupancy rate should hold up well since they cater towards the business travelers and they tend to be more resilient. So we expect RevPAR to increase by 11% for Hilton due to the lines of mass event and also the muted supply in Singapore. However, to take note, we expect FY24 DPU to drop marginally given the increasing financing cost with stabilization from next year onwards. So moving on to SESA rate, this is a high dividend yield play as it's trading at FY24 dividend yield of 8.7%. Also a very attractive discount of 0.8 times price to NAV. FY24 earnings will be largely supported by its very unique value proposition of value for money products, especially to ride on the consumption downgrade trend in China. And it also has series of very aggressive promotional events to uphold its tenant sales. So as shown on the graph, we expect tenant sales to increase by 3% year on year from the peak last year. And also, SESA rate has been actively taking on more RMB denominated loan, and currently it accounted for 53% of the total debt. Since LPR is on the downward trajectory, we do expect SESA rate to be one of the first rate to recover from the interest rate headwind. And in first half 24, they managed to decrease the all-in cost of borrowing by 0.3%. And the last country for REITs is Suntec rate. We do like Suntec rate because of its, again, very attractive valuation. As shown on the graph, although Suntec rate share price rallied last month, it's still trading at more than 40% discount to its net asset value. And compared to average S rate of 0.9 times price to NAV, this is very much discounted. And FY24 earnings will be largely supported by the very resilient rental reversion in Singapore side. And we expect office sector to achieve rental reversion around low teens, while retail to be around high teens. And Suntec REIT is also very much committed to its divestment plan. They aim to divest 100 million strata units by the end of this year and use all the proceeds to pay down its debt with a target gearing of 40%. And Suntec REIT is also, it also has the second lowest proportion of the fixed rate debt, which is around 55% hedged. And we believe they'll be benefit the most from the potential rate cut this year end. So with 100 basis point rate cut, this could potentially lead to 10% DPU uplift in FY25. And this is an airline country, China Aviation Oil. Yeah, so CAO is the largest physical jet fuel purchaser in Asia Pacific, and it also plays a very critical role in China's civil aviation industry. So profit for CAO mainly comes from two parts. First one is from its associates. So they own 33% of the stake in Shanghai Pudong International Airport, and that is the second largest airport in China. And they are basically the monopoly in the industry since they are the sole jet fuel supplier to all the aircraft departure and takeoff in Shanghai Pudong International Airport. And pre-pandemic, profit from associates accounted for more than 70% of the total profit. So as shown on the graph, air traffic has increased by more than 200% year to date. As a result, in first half 24, profit from associates increased by 180% year on year. And we believe the trend will sustain and at least increase profit from associate from 30 million last year to 44 million this year. So it's around like 50% uplift. Apart from profit from associates, CAO also supply jet fuel globally, especially to China, since China is one of the major jet fuel exporter and is still on the recovery phase. Yeah, so we believe this should support another 30% of the group's profit. And not only CAO has very visible earnings, they also have pretty attractive valuation. They currently hold 300 million cash in hand, and cash alone is making up about 50% of the market cap. And this is a recent initiation. We initiated Zixing earlier this month. There are so many stocks to buy in China, but essentially why we initiate Zixing is because Chinese government is encouraging food securities in China, and they have been advocating through providing subsidies for warehouse facilities and also allocating lands for the companies. So Zixing, we expect Zixing's sales for its fresh sweet potato products to increase by 70% year-on-year, and also increase by 30% year-on-year in terms of its processed sweet potato products. As a result, we expect PATMI to at least double in this financial year. And so here's a graph to show the PATMI increment. So we'll increase to 30.9 million in this financial year. And Zixing is also very actively sorting out additional revenue sources, such as animal feed. Because of the food security advocacy in China, they have been actively lowering the soybean content in animal feed. So we expect it to lower from 14.5% to 13% this year. So profit from animal feed is expected to kick in from fourth quarter 25 onwards. So this will translate into around 1.7 million profit next year. Moving on to the last country, which is sets. We believe profit revenue for sets will increase by 8% year-on-year in FY25, and this is mainly driven by the increasing cargo demand, air cargo demand, and also several repricing. So sets has just renewed one of its major customers' contract, which is SIA. It accounted for 17% of FY24 revenue, and the new contract took effect in second quarter 25. And we believe this is able to at least increase by 5%, and therefore translating around 45 million in FY25 revenue. So we believe the next quarter result will be exceptional since SIA's contract repricing will be taking effect. And we also believe SETS is able to fully capitalize on the recovery tailwind of airline industry, and also increasing cargo volume because of the Red Sea conflict. So due to Red Sea conflict, a lot of the time-sensitive products has been redirected from the sea into the air. And as a result, in first quarter 25, air cargo volume increased by 19% year-on-year. And we believe the trend is very much likely to sustain for the remaining financial year and increase by 15% year-on-year on a whole year basis, which will outperform the industry average. Yeah, so that's all for me. I'll hand over to Paul.
Okay, thanks, Mel. I know time is short, so I'll try to wrap up my session in 15 minutes, sorry, not 15 seconds. I'll be talking too fast. Okay, so the next one that we like is a small cap. We initiated, I think it's still trading at a record, the share price at least. So what is Alltech? So Alltech is basically, they build palm oil refineries, they build biodiesel refineries, and their order book has been growing about 50% for the last 3 years compounded. And we see them building more infrastructure facilities as overseas, Latin America and Africa. So there is momentum in orders, but the big one that we expect should be, or the Hong Pao draw is really the SAF, so sustainable aviation fuel. So what is happening globally for airplanes? They're going to put cooking oil into the plane, or palm oil, because of all. So basically, right now, SAF or sustainable aviation fuel is roughly about 600 million liters. By 2030, the target is about 23 billion. So if you do the maths, just about 38 times. So there's a big, huge opportunity for aviation fuel. Everyone is trying to go in and and if Alltech can reach it, can get a contract or a job from it, we think it will be, the order book will just skyrocket. And also, it's a chance to also build a new model. New model means, because when you do projects, the problem is after project is done, then what happens? And no order, no more jobs. So what you want is recurrent income. So we're hoping that they can get something in SAF and also build a recurrent income model behind it. The next one, okay, this one everybody knows, so let's not go there. So this is what we call the scars of experience, because I've been talking about this for almost 2 years, so a lot of scars. But we think the growth is still on track. There's still more pluses than the X. So they will still grow. So in the first half, taxi, believe it or not, actually earnings went up 40%. Not that, so mainly because what is different now for Comfort is they have Zig. So with Zig, they can compete. And when you have a platform, you raise commissions, all go straight down to the bottom line. The second thing is China is a pure rental business, the old model that they had. So that's also doing well. The big growth driver, like the title suggests, will be UK. So like the blue bar suggests, first half earnings are up 20%. We still expect growth coming up from this for Comfort. The other one is ST Engineering. By the way, after 10 years, the share price hit and managed to break after 10 years. So congrats for those who held up very long. So you see, this is the order book. That means the amount of jobs that they have. So what is different now is, so how you frame ST Engineering is that they will always get defense jobs. So, you know, in Singapore, we have food security. We also need defense security. In the event, touch wood, there is war, I don't think any country will come here and try and fix or maintain our planes or weapons. So by default, the authorities have to give jobs to ST Engineering in terms of defense security or food security, because you need someone locally to do it. So they will always have that 5% growth in defense. But what has different now is that they managed to do exports. So they're exporting ammunition. I'm not saying that's a good thing, but there's a new business for them. And the big one that's growing well is aviation. So as more and more planes, more capacity, more planes flying around, as all of us go for more holidays, a lot of these planes need to be maintained. And that's one of the big growth areas for them. So almost every division that's doing well, except one division that's called satellite. The problem with satellite is they got this new competitor called Elon Musk. So Elon Musk just shot up, his SpaceX is a big competitor for them, and they are revamping the business. But apart from that, all their businesses are doing well, and we still expect at least 2 years of growth for ST Engineering. This is another small cap. Hopefully this doesn't become the scars also, but it's turning around. So around 70% of the company is in cash. Price to cash flow is probably 2 times, the yield about 5, and they're still buying back shares. They allocated 60-70 million to buy back. Why is it trading so low? Is if you look at the blue line, a bit harder to see, but the revenue has been coming down because all their capacity was in China, and of course all the customers were leaving China. So, but they managed to build one in Vietnam, and we do see it returning. In November, when they release the results, we think that's where you're going to see growth, and hopefully the stock will be re-rated. This was the other stock that we just initiated. It's a Pacific Radiance. It's probably a well-known stock. It's been listed for more than 10 years. Yeah, don't have to rub your eyes. Yes, that's all losses, 100 million, 80. You can total it up, but it's a lot anyway. So as you all know, all the oil and gas companies, they're lucky to, not lucky. Very few survive after you have so much rate. But they managed to survive. At the peak, they had 40 vessels. So they are offshore support vessels. So, so they after a major debt restructuring, they had almost US 600 million of debt. 200 to 300, 200 plus million was forgiven. So thanks to the banks, just gave up. So okay, no need to pay back. Then what has happened is that they did a rights issue. So now last year they only had 1 vessel. So now they're having 3. But the bet on this stock is not just because they have 3 new vessels. The bet is that this company and the management has the experience, as they had as much as 40 vessels before. Now they are managing 3. It's not their own because they don't have the balance sheet, but the bet is that they will raise the number of vessels. And they also have a yacht. If you drive to Pandan, you see the yacht. You can't see that, I'm just kidding. But they have a yacht in Singapore, and they're also building vessels there. So that's why we think it's not just a 1-year story, it could be a multi-year story as they pile on more vessels. So you notice after so much rate, there's a blue there, 7 million. It's still a small cap, but that's why we initiated, because we think the trajectory is strong. And ultimately, everyone is just playing because the whole sector is, because competition has more or less half or cut down by 3/4. So when you have an OSV, there's a bit of shortage right now because no one is building, no one has the financing to build. The yacht also don't have space to build. Everyone building containers. So we think it's a multi-year growth story for them. So medium-term momentum, these are the stocks that in a nutshell, maybe nothing's going on in a very near term, so they just hang on there. So first one is Sembcorp Industries. For Sembcorp, you'll notice after they sold, sorry, there's a bit of a typo there, FY20, but anyway, after they sold or demerged or maybe wash their hands off Sembcorp Marine, lack of better word, demerge. After they demerged from Sembcorp Marine, the earnings started to climb up. You see FY22, and of course FY22 was when the oil crisis happened, and then it benefited them because they have excess gas, and all the power prices, all of us know electricity has spiked up, and they benefited because they got spot pricing. But moving forward, we think it will be a bit slower. 80% of the capacity is already been contracted out, which is good when it's stable, right? But the problem with stable means boring, right? Stable means nothing happening, another word. So we think, so what Sembcorp needs to do is they are building, the growth is coming from renewables. So that's why we think it's a medium term. You're probably only going to see the earnings recovery in 2025. So we think near term, nothing exciting for them for at least for this year, because renewables is the only growth area. For Keppel Corp is those stocks is in our model portfolio. Don't expect any strong earnings because they are impacted by property sales in China. But what you want is that little thing on the left. So anything could happen. So what they want is to monetize assets. So this is like an event-driven stock. Don't expect anything operationally to be strong. You're just waiting for them to sell something, and then that's okay. Again, the share price will climb. Apart from that, earnings not going to do, because Keppel is in a transition. So on the right, on your right hand side, they are moving into, they want to be like capital land investment. Hopefully they don't hear this, but they want to be like a CLI. That means don't have to come up with any money, use everybody's money, and then make money from other people's money, which is the best business, right? So that's what they're doing. They're in transition. That's why the funds under management from 85, they're targeting 200 billion. They want to be better than CLI with 100 billion. So if CLI move, maybe they also move up. But ultimately, you're waiting for this. The big, again, Hong Pao draw is the REIT co-vendor notes. If they sell that, the share price will spike. That's why we left it in a model. Just that anytime these things, of course, there's also the possibility of a M1 StarHub kind of consolidation. Okay, so I know everyone likes to trade semiconductor, so let me just run through. Structurally, so the lines here you see is smartphone sales. The problem with the electronics now is it's not really exciting growth. Smartphones are only growing 2-3%. Of course, you're talking about billions, but again, it's only 2-3%. So PC, notebook, also 2-3%. So the mind frame that any investor have is electronics isn't very strong. Of course, AI infrastructure is strong. But let me just run through all the stocks. I know everybody, those like to trade will have a view. So let me just give me my view. So venture, my worry for venture right now is the currency. So the US dollar, ringgit is actually, I think, up almost 9% in the third quarter. And most of these manufacturers have plants in Malaysia, and you pay ringgit. So right now your wages just spiked up because you have to pay ringgit. So we worry the margins might be hit in the near term. The rest of the semicons, the one that has the best momentum is probably Franken, and also Grand Venture that has earnings momentum. The rest, I think UMS, the problem for UMS maybe is they are losing a lot of share. They have one of their big customers, they're losing to a Malaysian competitor, and the new customer that they have in Penang isn't ramping up as much. AE So Singtel has done really well for us. I think it's about 20-30%. But because we think Singtel's, the reason why it's moved up is this thing called GPU as a service. But any data centers they're going to get is only in 2026. So I think we think the market might just run ahead. Of course, people might be speculating on some consolidation too. Again, this is just for illustration. This is the performance. Again, this is purely for illustration. You may or may not be replicate this because this is all our model computation. And okay, in closing remarks, I think because we probably want to leave more time for Q&A. So of course, everyone, there's a big SGX review. I know we're probably going to get some questions, but let me just preempt. There's a lot of media coverage, but I think the pertinent, the one that has probably summarized it the best is probably not because I'm SGX, but the SGX chairman letter. So if you read the letter, I think the emphasis here for the SGX review is not only just the supply, but you have to address demand. And then without institutional demand, domestic institutional demand, that means basically the local funds coming into the Singapore market, you don't expect the foreigners to come in, right? And again, I just quote him, if you don't support your own market, why would others support? Of course, I can't top what the SGX chairman has said. My only comment is, the other book I read that's probably maybe relevant is this book called by David Brazil. If you Google 1993 book, the title is called No Money, No Honey. So what it does mean is that no matter how much you sweet talk, no matter how good looking you are, no money, no honey. So you don't put money on the table, the SGX review may or may not be effective. In conclusion, the global slowdown we think is still underway, but we don't think there's any major recession. So, and we think the monetary stimulus is underway for the next 12 months, and then we are overweight REITs, construction, transport, and defense. Okay, thanks everyone. I think that's it, and thanks for taking the time. I can move on to Q&A.
Right, thanks all the speakers for the insightful sessions. I think we do have quite a lot of topic shared today, and I thank everyone for listening to us. Right, so I invite all the speakers to the table. All right, I need my colleagues come down to take the mic. All right. Okay, so what we'll do for Q&A, there's the physical audience and there's the online audience. So for those that are here in the Audi, all right, you all will raise your hand. My colleague will go to you with the mic to ask the questions. All right. For those online, we already take down some of the Q&A questions from the online part. All right. Okay. So any questions for the physical one first? Okay, everyone's still warming up. Maybe Jane want to share one question from the Zoom. Anyone want to take one question from Zoom first? Okay, I read the question now. Okay, so I think one of them is, why is it okay to go into Ascender's REIT even when their PE is so high? Same for CLI. Maybe Darren can share that.
Yeah, so for Ascender's REITs, like usually for REITs, we don't really value based on PE, but for valuation purpose, we use more of price to book. Yeah, but for CLI, we use PE. It makes sense, especially like for example, their FRE business, we use a multiple based on the earnings. So for CLI, wait, let me see the question again. Yeah, so why is it okay to go into CLI because of the high PE? But that's mainly because in 2023, the PE was very high because they had a lot of asset devaluations. So as a result, their portfolio had basically the income was lower, the earnings was lower because of like, if I remember correctly, it was like 400 million of asset devaluation. So that affected the earnings for 2023. So as a result, the PE was very high. But going forward, we think the portfolio valuations will start to recover or maybe flat. We don't see, if interest rates dropping, we don't see any more valuations upcoming. Rather, we don't see any more significant portfolio devaluations for CLI in 2024. So we think the PE will normalize back towards the more teens level, if I remember correctly. Yeah. Thanks.
Right, thanks, Darren. So I think there is two questions, actually more than two, actually three questions on SIA. Not sure if any one of you will be able to address where. Please highlight more on the SIA potential, especially their JV outside SG.
We have a sell call for SIA, and it's mainly because of its deteriorating operating metrics. So in first quarter 25, their yield compressed by more than 4%. And because of the firstly intensified competition, especially when the Chinese operator come into the Singapore market, and they also have like series of promotional events, and it's keep ongoing. Yeah, that's why we believe their yield is going to compress further. And some of their major Asia Pacific countries, such as China, Japan, and also Indonesia, is still lagging behind compared to pre-COVID capacity. Yeah, so we believe, yes, that's why we have a sell call for SIA. And also, there's a lot of one-off last year. They have income from selling of the aircraft and also income from the interest. That's why we believe at least PACME would decrease by 1 billion this year. Yeah, and for the regional partnership, yes, they do have a partnership with India, and they just and we believe the short-term effect will be marginal, probably will be more salient from next year onwards. Yeah, and it's very hard to calculate the financial effect at this point of time.
Okay, at this point, any questions from the floor in the SGX auditorium? In case I miss, anyone, any hands? Okay, no one for now. Okay, so there's one question. Last week, China bring out the big guns and we see the largest inflow of funds into the market. Is this the big turning point for Asia stocks, especially Chinese stocks in Hong Kong and Singapore? Or is this just a short covering and after that it will fizzle out? Maybe Paul want to address on this.
I think there's still going to be some momentum, like we mentioned earlier. Like I said, it's going to run on news now, so the news should be golden week, and maybe they'll be raising bonds. But you have to be worried because if elections come out and you have a new president, and he starts to the first thing you do, like T+1 second, is to go and impose tariffs on China, then everything will just fizzle out. So I think there's still room to move, probably the next 1 week, but you very short runway because he has to get past the elections. I think that's my big worry. But like I said, right now it's more career risk. That's why people all have to start piling up into China.
Okay, so next one is actually, I think there are some interest. I'm not sure if everyone here has been invested in before, but I think the question is, can someone discuss the outlook for commodity stocks like Wilmar, First Resources, and etc., which were once a favorite segment in Singapore? Yeah, so more of the commodities outlook.
I think Wilmar will do really well. I think if you look at the environment, Wilmar tries on changes in regulation. So what has changed probably the last 1 month is India has raised the import duties. So if you have foresight in India, you'll probably be stocking up palm oil in India. The second thing that's happened is that export levies in Indonesia has also been cut. And once they cut that, the refiners in Indonesia will benefit, go straight to the bottom line. It's just a windfall, just drop on the sky because they don't have to pay this levy. Then it will drop to bottom line. And the data for Wilmar is also soybean crushing is turning around. Hog prices are coming up. So almost every segment for them is doing well. I'm not sure sugar has come up, but it looks promising. I mean, the environment looks very promising for Wilmar, and palm oil prices are 6 months higher. So I think it looks promising for them. Yeah.
Okay, so we do have 2 questions from the academy room physically. So the first one is on any view on Yenlot. I'm not sure if you'll cover this. Second one is, what is the analyst view on Citrum since the year-to-date has spiked up, especially I think on Friday, if I'm not wrong.
Okay. For Citrum, there are only two reasons why the share price might move. Of course, they get a FPSO. They already told everyone they're going to get at least 7 FPSOs from Brazil to 2030. The other thing is probably there's an MAS investigation. I'm just, in theory, if I'm any country before they go into election, you want to make everything clear, everything clean. Your piece of paper must not have any smudge. So if you have that view, then all these cases have to be cleared. So that's one of the rumors. I'm not clear, but maybe that's one of the things that's also helping driving the stock. I'm still a bit hesitant on Seatrium because even though they got a record order books, the share price is still trading at a low. It's still down 21%. For me, people just take it as a proxy for all. Don't have a really strong bullish fundamental view on Seatrium. It's just a trading stock based off oil price. For Yan Lot, for me, if I want to play property, I don't think I want to go to Singapore to go and play property, although I'm SGX, right? So of course, yeah, but if you want to play, you go where the liquidity is, right? You go where, which is in Hong Kong, Corley, all those state-owned enterprise. At least you don't have to worry China overseas land or that, because these are all state-owned. You don't have to second guess whether they're going to go under. And you want to play the most liquid, because I don't think those who buy Chinese property is going to, but the sales is still weakening, and this is purely sentiment. And I think the authorities they are not increasing the supply. They just want to sell what is finished. So don't expect any new construction activity. But again, this is just a trade. I wouldn't be, for fundamentally, the best way to play China for me at least is to buy the consumer stocks, because that's where the government is pushing consumption rather than investment, which I think everybody knows.
Okay, so the next question, I think there's this one regarding between Trump and Harris, any thoughts on the impact to Singapore market specifically and or to ASEAN in general if either one wins?
Of course, if you look at the amount of trade surplus that Southeast Asia has, we are almost close to China. Our trade surplus for Southeast Asia used to be, don't hold me to the numbers, before 2018 it was probably 100 billion trade surplus. That means you talk of Vietnam, how much they sell to the US. Now it's hitting 200 billion. So if I am the new president, he looks at it not just for economic benefit. I mean, he doesn't look at it like, impose tariffs, I get more money. But he looks at it as a tool. So he may say, okay, Southeast Asia, you're very close to China. Maybe I should raise your tariffs. I'm not saying he's going to do it, but there is always that risk. Whereas the other candidate, the vice president, has never mentioned that. So, we're very sensitive not to mention about president candidates, but I think it's very obvious, I mean, the risk for not only Singapore, for the whole of Southeast Asia, that if you have a trade war, it doesn't benefit us. Yeah.
All right, I think there's also some questions regarding the REITs. So some of the REITs mentioned is Japanese Daiwa REIT. Another one is on the Mapletree REIT itself. They're asking how is the occupancy for Mapletree Industry, and also how is the US portfolio doing for the REITs?
Yeah, so the first question is comment on Daiwa House Logistic REITs, I believe. Yeah, so for Daiwa House, it's a little bit different because for them, they're based in Japan. So in Japan, interest rates are rising. So that's the first point, where the rest of the world, interest rates are coming down. So that's really a kind of a negative point for them. But going forward also, their leases also, most of their leases, they do not have escalation. So every time that they renew their lease is the only time that they can increase their rents. There are some positive signs. Like recently, they managed to sign a lease, a significant lease that has a escalation clause, a small escalation clause, but that's better than nothing. So going forward, at least they can have some rental escalations for that lease. But generally, most of their properties, they do not have any escalations. So basically, the top line stable, but with higher interest rates expected, the DPU will likely to decrease going forward as compared to the other REITs where the interest rates are coming down. They'll have lesser interest expense, so DPU will likely increase, even though the MPI, even assuming it's constant. Yeah, so that's the so-called the negative for Daiwa House. But as a standalone basis, Daiwa House is still relatively a very stable REIT which pays about 7% yield. So it is still quite attractive, but just based on relative terms, currently it's not that attractive because of the interest rate environment. Yeah, so that's for Daiwa. I think there was US also. So for US office, basically we noted that two of the US office REITs, Core, Capital Pacific Oak, as well as Manulife US REIT, they have halted their dividend payments. While Prime US REIT, in the most recent half, they paid only 10% of their distributable income. So basically, if you are you're investing in US REITs in the current point in time, you are not expecting much dividend yield, but more of a capital gain appreciation. And it's really based on the fact that interest rates are coming down. So with lower Fed rate, basically the SOFR, the SOFR will benefit immediately from lower interest rates. So they will benefit immediately from that, as well as the fact that the property valuations, as interest rates come down, cap rates will likely compress. So basically valuations there is potential for valuations to improve, but we think there will be a delay. So maybe not this year, maybe by next year, the valuations will improve. And also with lower interest rates, we expect the transactions volume to pick up. So Manulife, they divested one of the assets, Capital, even though it's at quite a steep discount to valuations, or rather FY23 valuations, it was 150 plus million, but they only managed to sell at 110-ish, if I remember correctly. So it's about almost 30% discount, but it is a step towards their recapitalization plan where they have to divest assets and pay off some of the loans because their gearing is, after all, if you remember, they're still in a breach condition. Their gearing is above 50%, so that is still the issue for them. They still have to divest some assets to bring it down lower. Yeah, so that is, but basically for the outlook, the leasing momentum is still quite weak. We still think there will be a little bit of weakness going forward for leasing, but we expect to pick up next year. Right now, we think occupancy will likely trend around 80-ish%, below 90%. So there is still some weakness, but basically, if we invest in the US office REITs, you are looking for capital appreciation as they are not paying any dividends. Yeah, so that's just some of my comments for that.
Okay, so the next one, maybe there's no physical questions. All right, so another just mention also at this point is that we might not be able to cater to all questions from the Zoom or the physical audience. If your question is not answered, you can actually go to the PoemsTree app. The research team have a community group on PoemsTree. If you ask questions there, they will also review over time, and then they might reply you over there as well. All right, so back to the questions. Maybe this next one can be by Zin, regarding more on the technical view. So there is this question asking, with the current market situation and political regional conflict, what is the chances of a big market correction? As well as, do you think STI will break up to its all-time high anytime soon, or any end of year target for STI index?
Yeah, thanks for the question. I think first up regarding the geopolitical situation, I think most of the time, as we've seen in the past, like the Russian-Ukraine war, and when it's previously last year around this time when the Middle East war broke out, market usually is down about 1 to 2 days, then subsequently recover. So I don't think this time there will be a very big major correction happening in the market. Again, then for STI, I think momentum is still very strong. I think there's still room for upside for it to go close to its all-time high at 3,906. Currently, I think it's about 300 points off. So I think I do expect maybe 3,800 or 3,900 end of this year. I think there's still a good chance for it.
Okay, so that sounds like good news for the STI investors. All right, next one is, will the China current stimulus benefit Yangzijiang Finance? And any view on the counter? Do we have any view there?
Actually, for Yangzijiang Financial, their bad debt has kept increasing because of the bad macro situation in China. Currently, it's around 40%. And we believe the current stimulus do help, and Yangzijiang aim to lower their bad debt rate by the end of this year. By suing basically the borrower, and also they want to prolong the timing of refinancing.
Yeah, I think our view is that if you want to buy Yangzijiang Financial, why not just buy a Chinese bank and they give you 10% yield. I don't see why you want to make life so hard. Yeah. You know, like you buy DBS, well, look so hard to find a small cap, maybe up 30%. Something similar to that lens. No, don't have to try so hard. Yeah, because the problem for Yang Financial is they're in a transition to, sorry, I keep talking about this. So most of their loans was in China. Now they're moving, taking all the money coming into Singapore and build a private equity business. Of course, when they're taking, you don't want to be, as a shareholder, you take your time and do it probably 2-3 years before you see any profit from Singapore. And you're talking about private equity, you have to look for investments. Then after investments, look 2-3 years later, get the return from the investments and then go and pay shareholder. Well, like 4-5 years, yeah, it's like the scars of experience again. It's like very, very painful to ride this journey. Yeah. Just buy a Chinese bank, I mean, if you really want the Chinese exposure. Yeah.
All right, so similar context, I think there's a question on what is the outlook on Genting Singapore?
Okay, what worries us for Genting Singapore is Thailand. Okay, not because everybody, because Thailand is planning to build 8 casinos and they seem very determined to do it. The problem is not that the casinos will be built. The problem is the news flow of the casino. Is that's going to hurt the stock? We think the numbers could still do well because the China visitors are still strong. But it's the news flow that could hammer this stock. Because Thailand, they say, oh, we're coming close to a new casino. Oh, your share price is going to get hit again. Oh, we are coming, the legislation is getting closer. Oh, you're going to get hit again. So we just worry that this could be a up and down kind of a movement for the stock because this will be the big overhang for Genting Singapore. Again, whether or not they actually build a casino like Japan after so long, also still nothing has been done. But the news flow could hurt the stock. I mean, that's our own view. I'm not saying that it's right or wrong. But with the Chinese arrivals, it should be well. But we're just very worried about that. You might put a cap to the share price.
All right. Next question will be regarding to with the rate hike. Rate cuts, I believe the question may be very strongly. Coming in the next few months, should the consumer stocks benefit in Singapore?
You should ask some banks question. The consumer for Singapore, apart from Sheng Siong, most of it is dependent on Indonesia and Thailand. You know, Thai Bev, your Jaffa. So the weakness in the US dollar is actually very good for consumer stocks. In general, because what it means is that their currency is strong because they import a lot of meat, everything is all commodities, all in US dollar. So the strength of the Asian currencies is actually very broadly speaking good for consumer stocks. In listed, you're talking about your Thai Bev, your Jaffa, and so forth. Because ultimately, for consumer, the only one name is only Sheng Siong. Yeah, but the rest are all, yeah.
Okay, so we are reaching the end of the Q&A. So like what Paul said, let's have some bank questions. So for the bank questions, there's 2 parts, right? So one of the question from the audience is what is constituting within the trading income for the banks? The second one is in particular to DBS. Let me just try to find it. Too many questions in between. I think the person was asking regarding the DBS bank, how much the upside is there going to be with this change of a CEO and whether there's an impact from this change.
Yep. So the first one, simple, trading income, it's mostly the buying and selling of their financial sort of like instruments. Okay. Yeah. So it's like stocks, bonds, FX. Yeah. So I mean, if you just think back about the chart I showed earlier, you look at the VIX. It doesn't really follow the VIX per se because there's this big spike up during COVID, right? But we do feel that there could be a possibility, especially with what happened during the carry trade, that we could see some increase in the third quarter results for trading income because it's been growing quite strongly. Now, moving to the second question, you're asking about DBS and whether or not the share price has peaked because of the change of CEO. So I would say it's not really. Piyush has been in charge of DBS for the last, I think, 15 years, right? And the new CEO, the handover process is on the way. And she's not new to DBS, right? She has followed Piyush from his Citibank days when he moved. So then he brought her over. So she has been in all parts of the bank, right? She was in, I think, in the corporate side, then now she went somewhere else, and then she's been moving around. So I think what has been in the mind was that she was already getting prepared to be groomed to sort of take over, right? I don't think she was one of the front runners at the start, but I think when you look at how her path has been, going through all the different sectors of the bank, I think it's quite obvious that she was sort of being groomed to take over Piyush's role. So I think it will be a good change because, Piyush has been doing that for 15 years. It's rather long. So it'll be a good change, but I think the market may be a little bit undecided on where she will be heading. So from now, it's still growing strong. DBS is still doing well, but what would she be? How would she be changing? Or maybe she won't be changing anything at all. Yeah, it's really hard to say for DBS at least.
All right, thanks for Paul and the team for the Q&A. Right, so our next part, right, will be our sponsor sharing. Right, so after each sponsor sharing, there will be a Kahoot quiz where the top 3 winners of each Kahoot will get cash voucher prizes that will be sent to you through digital means. And after that, we'll have the grand lucky draw. So just to reiterate, right, let's have a hand of to thank the team first for sharing. Right. Okay. So I'd like to just remind everyone, do not throw away or misplace your flyer, because your flyer, the top right hand side, is your lucky number. Okay. So the lucky number is the one that we will use for the lucky draw, right? The top 3 prizes. If you misplace it, then you might not have a chance because there's no more lucky draw ticket there. Right. So our next speaker will be Marcus Ng from SocGen. All right, so he's a VP. He will be sharing more about the very exciting one that is coming up to Singapore. I think a lot of you all want to trade US Magnificent 7 counters. And right now, SocGen has brought it to trading within Singapore, SGX listed Singapore hours Sing dollar. All right, but before I pass the hand to him, I'd like to just share that on our Poems 3 app, outside, if you have went past the booth, the column, one of the booth is on the SDR, Singapore Depository Receipt. We have a limited time voucher. Just now I shared at the very, very start. The voucher, the $50 and $15 voucher, if you trade the SDR, all right, for no commission, all right, if you trade SDR of $500, you get $15 cash credit. You trade 5K worth of the SDR, you get $50 cash credit within 14 working days. For this voucher, you have to redeem on the Poems 3 app. So if you have your Poems 3 app, do just go Poems 3 app. All right, go now. Go to under the Me tab. Inside there is a rewards, this collection one. The vouchers is limited. There's less than 100 left from what I understand just now when I was outside. All right. So now I'll pass the time to Marcus, who will share more about the very exciting US DLCs.
Thanks, Wante. Okay, hi. I think good afternoon, everyone. It's 12 o'clock already, so good afternoon. I know I'm holding you up between me and lunch, so I'll try to keep this quick and short. All right. So in the next 10 minutes to 15 minutes, just give a quick view of what we have just launched just yesterday. It's fresh out of the oven. All right. For those of you who are familiar with the daily leverage certificates, DLCs, you will know that, Society General, we started these DLCs back in 2017, listed on the SGX. We've been covering Singapore and Hong Kong underlyings, Singapore and Hong Kong indices, Singapore and Hong Kong stocks that offer you 5 times and 7 times leverage exposure. Right now, we are doing US stock underlyings, Magnificent 7 stocks that we've just launched yesterday. All right. So we have come a long way over the last 7 years. So this is our 7th year that we have the DLCs listed on the SGX, Society General. All right. So we have now over 200 DLCs listed on the SGX, and we have populated the shelf on the table on the left over here. All right. So we do have a Hang Seng Index, Hang Seng Tech, and Hang Seng China Enterprises Index. Those have been very hot in the last couple of weeks. I think of those of you who are in the market, you will know that the China rally is going crazy. All right, so our Hang Seng indices, our Hong Kong stock DLCs 5 times and 7 times leverage have been quite hot recently. All right, Singapore stocks always there. And also now we have our US stock underlyings. All right, so we used to have indices only, NASDAQ, S&P, Dow Jones. Now we do have the Magnificent 7 stocks, DLCs up to 3 times leverage. So 3 times long and short leverage on the Magnificent 7 stocks, your Nvidia, Tesla, Apple, Microsoft, Google, Amazon, and Meta. All right, so this is our little robot. For those of you who know the DLCs, we are used to be Kung Fu masters, more traditional type. But now we have a Kung Fu robot to represent our US stock DLC. So you'll see more of this little robot in time to come, all right, with more of our educational efforts. Okay, so this is our shelf, US stock DLCs. We have listed already the Nvidia, Apple, and Tesla, 3 times long and short DLCs on the SGX yesterday. All right, so we had a very good start on this US stock DLCs yesterday. The rest of the Magnificent 7 stocks, Amazon, Meta, Microsoft, Alphabet, 3 times long and short DLCs will start trading on the 8th of October. All right, and then we will have the full Magnificent 7 stock shelf. All right, you can scan the QR code. We have a dedicated page on our website, dlc.stockgen.com, where you can find out more about the US stock DLCs, how it works, etc. But let me give you a very quick preview today. First of all, what are the benefits? All right, so these DLCs are all listed on the SGX securities market, okay? You have 3 times leverage exposure on the Magnificent 7 stocks, 3 times long and short exposure. So you can go 3 times long or you can go 3 times short. If you are bullish, you will buy the 3 times long DLC. If you are bearish on the Mag 7 stocks, you will buy the 3 times short DLC. All right, so you can trade both directions of the market. With the US market at all-time high right now, maybe the 3 times short could be quite interesting for you in the short term. All right, so this is one of the very new, one of very few instruments on the market that allows you to take a short exposure to the US stocks with 3 times leverage. All right, so these are all listed on the SGX securities market. So they are traded only during SGX market hours, 9 a.m. to 5 p.m. But this represents a new trading window for investors. A lot of the corporate earnings, they come out after the US market close, say 7 a.m., 8 a.m. By the time you wake up, US market is closed already. But if you want to react to these corporate earnings results, come 9 a.m. Singapore market open, you can use our 3 times long and short DLCs to react to the market, the company earnings results that was just released at 6 a.m. or 7 a.m. in the morning. Or if there's any high impact news during Asian hours, China-US tensions, recently we had the Microsoft CrowdStrike issue, during 1 p.m. in the afternoon or 2 p.m. in the afternoon Singapore time, you can react to such high impact news using our 3 times long and short US stock DLCs. All right, so this is a new trading window. And also you can trade it on your POEMS account. So any regular brokerage account, including your POEMS account, you can trade the DLCs. So you trade them the same way that you'll buy your DBS shares or your UOB shares. You don't need to open an account with SocGen, okay? Number one question I get, do I need to open an account with SocGen? No, you trade it on your regular stock brokerage account, POEMS, or any other stock brokerage account, you will be able to trade the DLCs. And you can trade them in Singapore dollar currencies. Recently, the US dollar has been really weak against the Sing dollars. All right, so this one, you don't need to change your money into US dollars to gain Okay, so DLTs, I mentioned the basics of DLTs. Those of you who are new to it, we provide that fixed leverage, 2 times, 3 times, 5 times, or 7 times leverage on the underlying stock or underlying index on a close-to-close basis every day for the DLC. So you can see over here, NVIDIA is up by 2% on day 2 versus day 1. So my long NVIDIA DLC, 3 times long NVIDIA DLC will be up by 6% on a close-to-close basis, US market close-to-close basis. While my NVIDIA 3 times short DLC will be down by 6%. So if conversely, NVIDIA was down by 2% on day 2 versus day 1, then my 3 times short NVIDIA DLC will be up by 6%, while my 3 times long NVIDIA DLC will be down by 6%. So this happens every day on a close-to-close basis. Those of you who trade the TQQQ or the SQQQ, the Process Ultra 3 times long and short NASDAQ ETFs in the US, this is exactly the same kind of payoff. All right, exactly the same kind of payoff, but we are in a certificate structure, whereas those TQQQ, SQQQ in the US are in a ETF structure. Okay, so the US stock DLCs, number one question on people's mind is, hey, US market is closed during SGX hours, right? Then how does the US stock DLCs work? All right, so the basic principle number 1 of the US stock DLCs, as I mentioned a few times in the last 5 minutes, is that we will provide that leverage 3 times on a close-to-close basis. So for this US stock DLCs, similarly, we'll provide that same US 3 times leverage performance on a US market close-to-close basis on the underlying stock's daily percentage performance. So in this case, example over here, if the US stock at $100, it closed at US market T session at $100. Okay, and then fast forward to US market close 4 a.m. Singapore time, underlying stock closes up by 15%, up 115. All right, up to $115 US, up 15%. My DLC closed at $1 on US market close T session. It will give you that 3 times performance of the underlying stock performance of 15%. So it will be up by 45% to rise to $1.45. So this every day on a close-to-close basis, you get the underlying US stocks percentage performance multiplied by 3 every day on a close-to-close basis. Okay, so that is during US market close-to-close. Then what happens during SGX market hours, 9 a.m. to 5 p.m. when the US market is closed, right? So in this same example over here, if the US stock was closed at US market T session 4 a.m. this morning, closed at $100, intrinsic close of the DLC is $1. Come SGX market open at 9 a.m. So from 4 a.m. to 9 a.m., the underlying stock say reported better than expected earnings results, right? It up by 6%, all right? Because it reported earnings very good, 6%. My 3 times long DLC will track this performance of the US stock by 3 times that, all right? So you're up by 18%. So this US stock during SGX market hours is based on the performance of the stock that is traded on alternative trading systems during Asian hours. Nowadays, even Phillip as well are offering 24/5 trading of the US stocks, so you can trade US stocks during Asian hours. There have been a rise of such exchanges and such alternative trading systems in Asia that allows people to trade US stocks during Asian hours. So Phillip is one of them that offers US stock trading during Asian hours. So the DLCs will track those prices closely with that 3 times performance. So that's where if on Phillip liquidity platform, etc., or alternative trading system platforms, the stock rise by $106, my 3 times long DLC will be up by 18% at 9 a.m. Say at 9 a.m., you decided that, okay, the company reported very good results. All right, so I want to ride on this bullish momentum and I want to buy and go long on this US stock. So you can buy the 3 times long DLC at $1.18. And if indeed the US stock during SGX market hours 9 to 5 p.m. continue to rise further on these alternative trading systems, it rise further to $110, up 10%. My 3 times long DLC will track that 10% gain with the 3 times leverage to rise to $1.30. All right, so at this point, you can sell off your DLC back to SocGen at $1.30 to book the profit of $1.30 versus $1.18. So that's your profit, all right? But you can also choose to hold the position overnight. All right, you can choose to hold the US stock DLC overnight, but it's important for you to know that you cannot trade the US stock DLCs during US market hours. You can only trade it during Asian hours, SGX market hours, 9 a.m. to 5 p.m. So if you don't sell off your DLC before SGX market close by 5 p.m., you will take on the exposure of the US stock overnight and you won't be able to manage your position. So you have to be comfortable with that fact that you can't manage your DLC position when the US markets are open at night. You can only manage it the next morning when SGX market open. But you continue to track the US stock exposure. So if, say, this US stock Tesla, okay, continue to rise during US market hours, due to the very good earnings results, it rises to $115 as an example. Then my DLC will also continue to track the performance of the US stock during overnight US hours with that 3 times leverage to close at $1.45 at US market close 4 a.m. But you cannot sell off your position yet. Okay, you can only sell off your position next day, SGX market open T+2. If US stock is still up at $115 on the SGX market open T+2 9 a.m. session the next day, then our quotes will be at $1.45 around there, and that's when you can sell back to us to lock in your profit of $1.45 versus $1.18 your purchase price. Okay, so this one is a very exciting product for us, the US stock DLCs. We are expanding the shelf. We did Singapore stocks, we did Hong Kong stocks, now we're doing US stocks with 3 times long and short exposure. It was just listed yesterday. So it's very exciting for us. For these US stocks, I think for those of you who are interested in trading the US stocks, this could be one. If you want to stay within the comfort of SGX, you want to trade it in Singapore dollar terms, or if you want to go 3 times short on the US stock, then you can consider our US stock DLCs. All right, all this information can be found on our website, dlc.socgen.com. So please do check it out, including the risks. And also we'll be publishing the price of the underlying US stock reference price. So during Asian hours, you'll be thinking, where's the US stock? Where's Tesla trading at? Where's Apple trading at? Right? During Asian hours, 9 a.m. or 10 p.m., we will publish the price on our website for each of the US stock DLC, the reference price of the underlying stock that you can see, or you can go and see Philip's account or your other brokerages that offer such US trading of US stock trading during Asian hours. Okay, so I will end here. Just a very short preview of this US stock DLC. We've just listed it yesterday, but you are getting a first-hand insight on this US stock DLC. You can find out more information on our website, dlc.socgen, under the US market tab here. Visit there. You'll find all the information on the US stock DLCs over there. But if not, please feel free to call our hotline at 6226-2828 on our website. My team and I are on standby to answer any questions that you have. All right, so last 2 things. You have a promotion on your leaflet on the US stock DLC by Poems. So any 2 buy trades on the US stock DLCs, you get $88 cash credit. So take a look at that. All right, and you should have gotten my recyclable bag. Okay, that one has our website link on that. So please go and visit our website. There are videos as well over there under the education tab and in this page as well to tell you more about how the US stock DLCs work. All right, so do check it out. I hope that this will be interesting for you as part of your US stock trading. It's come a long way, Hong Kong stocks, Singapore stocks, but now we do have US stocks on the DLCs and it can be traded during Asian hours. All right, so thank you so much.
All right, thank you. So you can also reference from our US Asian Hour trading page on the Poems platform. All right, so thanks, Marcus. Next, we will have the first Kahoot for this session. So while the Kahoot is being switched over to the screen, everyone, both online and physical, can join. So get ready your phone. You need a QR code scanner or go to the Kahoot website if you have, or the app if you already downloaded before. So let's press the start button first. Yeah, so there will be a number. If you go by the website, the www.kahoot.it, key in the number. If not, you can click on the QR code. Can my colleague click on the QR code first? All right. Yes. So do scan this very big QR code to join the Kahoot quiz. While you are joining in, let me explain some of the rules. Right. There will only be some questions. Right. So not many. Right. And only 3 winners. So if you are so lucky to be the 3 winners, don't be excited and close the tab. Screenshot first. If you are here physically, look for any of my colleagues outside. It will guide you to who to look for to write down your details. Alternatively, if you are on Zoom or if you want to send email, you'll be sending the email of the screenshot with your name and a contact number to tj_team@phillip.com.sg, right, to redeem your prize. Only the top 3, all right? So don't later you 10th place, you try to email me, I will say thank you for participating only, all right? But if you are top 3, congratulations, we will send you the prize. You'll be a digital coupon. Very unfortunately, if you are overseas now, or if you are based overseas without availability to redeem the prize in Singapore, you might not be able to redeem. Unless you have Singaporean friends that you want to share the link, if you win, you can do that also. All right, so you can still win, but you cannot redeem the code. You can actually pass to your friends or family members if you are tuning in and staying overseas currently. I think there is a very good turnout, one of the largest I have seen so far, more than 200 participants, only 3 winners. Next time we have more winners if possible. All right, so we do have more events coming up from all our sponsors. All right, so do look forward to them. We have with SocGen some upcoming event. The next one at the Raffles City Tower will be on 24th, right? 24th of October. Specifically, a full session on the US DLC. If you have not understood, you want to find out more, feel free to sign up. If you're not sure how to sign up, look for our colleagues outside later on. Right, so I think I have to start soon because we do have 2 more sessions after this, 2 more Kahoot and 2 more sponsors sharing. So, my colleague, right, count down 5 seconds and we will start. Right, 3, 2, 1. You can still join in along the way as I'm speaking. The number is still be on top, I think, showing the code to join. First question should be a fairly simple one. First quiz. What is the listing date of the first batch of US stock? Yesterday, what date? Yesterday. Yesterday is what date? I think very simple. Yesterday, yesterday. If you tell me yesterday, December, then no, nothing can help you already. Yesterday is 4th of October. Wow, got 23 put 8. First batch yesterday. You all choose the one next batch one. Right, next. Ranking, very exciting. Oh, very fast. This one very fast. Next question. 964, very fast reaction. Question 2. What is the initial batch of US stock DLCs that SocGen will launch? What? Hard. But you must think. First batch. Just now we say what? Only how many stocks? Only 7. So 7. Where is 7 here? Well, if you don't know where is 7, then I have no choice. But actually, I really like if you can put in Netflix. Netflix will be a good idea. All right, so people choose Netflix already. Reaction time, all press red color, is it? Next question. Very fast, we see ranking. Okay, got change in ranking a bit. Question 3. What is the leverage offered for SocGen's US stock DLC? 7 times, 5 times, 3 times. Just now, Marcus keeps saying this number. How many times? My hand is here. You can see my hand, you can see the answer. Online one, no choice. You must see from zoom in my hand. Okay. Last second. Okay. Majority get correct. Right. They do have 7 times and 5 times for SocGen's DLC, but for US, it's only 3 times for now. Right? So congratulate for the first 3 for now. Question 4. Last 2 questions. Last 2 questions. SocGen first batch traded in what currency? USD, Sing dollar, or both USD and Sing? What currency is the US stock DLCs traded at? This one the determining factor, I think, for most of the people. Your reaction time fast also, you might choose wrong. See, I knew. Confirm will have people choose left and right side. Okay, so 140 people get 140 people. Okay, WCH still leading. Very good. Last question. What is the stock code of SocGen, NVIDIA, long and short? Leon, he never share. You go look, you can see. But you see what name is the closest to in the money, you want to buy in or you want to short. This one very tough. Very tough. But if you know the real stock code, you know what not to choose. Because you see, everyone choose the real stock code. How can the stock code be the same? Right, you choose NVDA. NVDA is the stock code. So now we will see the 3 winners. Okay, the 3 winners, do let me know if you are in this room or let my colleague know if you are in the IPO arena or in the academy room. KCK, SH, and JTY. Oh, change it. WCH disappeared. Who is JTY? Any hand? JTY? Don't know. Okay. SH. KCK. Oh, KCK. Okay, we at least have one. Don't tell me then 0 winners from this room, then I very malu, you know. I give you answer my hand already. Okay, let me just confirm if I have the 2 other winners, my colleagues will confirm. Is there any winners in ICGX, IPO Arena, and in the Academy room? Do take note. So we have 1 winner here, KCK, for this session. All right, next, very fast. We want to move very fast, later you can eat lunch also. Next speaker we have upcoming is a very pretty lady, Miss Jamie Cheng from Macquarie. She'll share on the Macquarie's offerings. And if you went to their booth, they have shared quite a few exciting things, especially in this volatile market. If you are trading in Singapore, trading in Hong Kong, you will find all the volatility interesting. The slides, please. Yeah. So, Miss Jimmy.
I didn't come up because you said, pretty speaker, and then I was looking around, who are we missing? Hi, good afternoon, ladies and gentlemen. My name is Jamie. I'm the head of Singapore Warrants for Macquarie. And, today I think I was part of you. I heard about all the exciting, research ideas, stock ideas, target prices. And I guess all I have to say is we are in the midst of a very exciting market cycle, right? We've got the Chinese Hong Kong stocks moving finally. And then we've got the US also moving. We've got elections coming up. But more importantly, starting from this month end, we've got basically the start of earnings season for the banks and what have you, a lot of Singapore stocks, US stocks, etc. So I'm here today really to introduce a product which I hope you can use to profit based on the views today that were being shared. Or even if you're looking at stock that wasn't covered today, right? But what's happening is maybe you are seated there and thinking, very exciting stock ideas, target levels, you have won over, but you are probably missing a bit of a capital, investment capital, a bit short on that. Why? Because maybe you've already been vested, you've been sitting on your long Hong Kong stocks for a long time, and now the momentum is coming and you don't want to cash out yet. Or simply, you're looking at a way to magnify your returns, right? You're not happy with a 5% yield. You're hearing about people making basically 200% with the US stocks and Hong Kong stocks lately, and you want to magnify, but you're afraid you're a bit late to the game. Then how? If that is one of the things on your mind, or simply you just want to take a broad view of the market, after all the stocks you've heard about, you want to diversify your portfolio a little bit by taking a broad view of the index. Well, then you're to the right session today, because I'm here today to talk to you about this product called warrants, which offer you a chance to do all that if that was one of the scenarios that you find yourself under. Basically, there are essentially only 2 types of warrants, a call and a put warrant. A call would track the underlying higher in the short term, and a put warrant moves inverse, which is something a lot of Singaporean investors do not use enough of. And why do I say that? Basically, when Nikkei came off 18% in a period of a week, not many people benefited from that. And basically, when China and Hong Kong came down over the last few years, with the lack of stimulus, every time they came out with one, until the recent one, it was a disappointment. People didn't do anything. And more importantly, people who heard or have had a glimpse of how the earnings seasons could be bad because the economy is looking shaky, they didn't know what to do with their portfolio of your DBS shares, SIA shares, UB shares, etc. Okay, and this is where hopefully you guys will learn more about, which is why today's topic is leverage, but also protect. How? With put warrants. Why? Because they move higher when the underlyings come off in the short term. Only in the short term. Why? Because if you're a long-term investor with a portfolio of shares, you are long-term bullish. You're really just fearful of the short term, correct? And this is a product that you can use. Now, at this point, some of you are sitting there thinking, hey, call and put warrants sound a lot like call and put options, which you may have heard about. So what's the difference there? Well, warrants are a form of options, but I would say they're even more straightforward. How are they straightforward? Basically, because you can't short a warrant, just as you can't short a security overnight. What that means is that it takes away the whole headache of trying to find out and learn about your butterfly strategies, the straddle strategies, your strangle strategies. And to be honest, hearing about these strategies alone suffocate me, because I'm in the options business, a warrants business, but I don't necessarily know about all the strategies that option traders need to know to best use it to their advantage. Warrants are a very straightforward product. You either buy a call because you're short-term bullish, okay? Or you buy a put if you're short-term bearish. And what will they offer you in return? They will offer you the opportunity to magnify your portfolio. Let's have a look at an example of how you can use a call warrant very recently, as recent as last week, to profit, okay? This is a newsletter where we publish every morning, and we really only send it out in the morning with a trade idea or the biggest news of the day that as an investor, we hope you know about. And this is what we ran on the 24th of September. We said, basically, the Bank of China announced bazooka stimulus, something that's never happened before. And immediately what you will see is that the HSI here in this chart has finally moved above its recent highs. Those of you here who are technical analysts, what you notice that is immediately moving above where it was in May. And technically, you know, by the time this news came out, it was at 19,000. You think, okay, if you can sustain above 19,000, it's probably going to go to around 20,000. And let's see if you can hit above 21,000, right? So this is the progressive resistance levels that you're probably looking at, you know, for simplicity's sake. And if so, what would have happened if you had bought a call warrant? Because in this case, you're bullish, right? You're thinking technically it's looking good, holding above a previous recent high. Fundamentally, in terms of news in the short term, you think, hey, it's the boost, right? In this case, if you had bought a call warrant instead and you haven't exited because everyone is now saying that this momentum is looking like it's got legs, right? After being, you know, undervalued for so long relative to other indices. If you had gotten it the very next day after our reading our newsletter on confirmation of the technical support at 19,000, if you had bought the futures, you have made 18% today, which is super impressive and probably a little bit scary because it's a margin product. But if you had bought the warrants on your Poems platform, basically how much would it have cost during this period on the 25th of September? You could have gotten it at 6.4 cents. Very low amount of capital requirement because it's 6.4 cents. Or if you're a bit more conservative, you could have bought something that was 22.5 cents, for example. And during this period, how would they have performed? You will see basically they moved up anything between 180% to 400%. So yes, 18% is impressive, but basically what warrants have offered you the opportunity to do is it's grown it by more than 10 times, more than 40 times for some of these warrants. Now, over here, you see the gearing or leverage. And what this means is that it's moved, it shows you how many times more is moved relative to the index. And this product, I hope, at this point, just showing you the leverage alone, shows you the difference between warrants and other leverage products that you might have heard of, whether it's your CFDs or DLCs, etc. We do not have fixed leverage. There is something for everyone. You decide what kind of leverage you want. And the more the underlying moves in your favor, the more leverage you will enjoy. In this case, more than 22 times for some of them. Okay, now, how can we use put warrants? Again, I want to refer to you an article that we published on the 31st of July about the Bank of Japan rate decision. Obviously, rate decisions these days are really big, mainly in the US and in Japan, because they're moving inversely from each other, right? One is getting dovish, one is getting hawkish. When we ran this on 31st of July, we basically said, hey, you need to know that there is a Bank of Japan rate decision today, and it looks like something could happen. And indeed, what happened next was that the Nikkei dropped 16%. Over what period? Over only 5 days. It was down 16%. And if you had bought a put warrant, right? Also because if you look at technically, I don't have a chart here, but 30, you know, as it came off from 42,000, the support levels were giving way at your 41,000 level, 40,000 level, and then 39,000 level. And you thought, hey, this is a good time for me to hedge with a put warrant, or simply you just wanting to profit from a downward move. And if you had bought the 2 Nikkei put warrants, either one of them available on the SGX, you would have made 197%, 122%, which is between 7 to 12 times more than the underlying. And ladies and gentlemen, this is exactly how you can use put warrants to hedge against short-term moves. And I highlight short-term, why? Because if you're a DBS shareholder, like I said, earnings season around the corner, you will be, and then of course all the other companies will follow, then you're a little bit worried about this quarter, or the last quarter, I should say, economy slowing down and etc. Then you can actually use a put warrant to just hedge in the short term. What if you were wrong? The market did not pull back in the short term. Then fantastic. You cut your losses. Again, bearing in mind that the capital outlay for this is so small, so it's only a fraction of what you hold on your portfolio. you exit from that, and then you continue to stay bullish and enjoy the gains on your portfolio of shares. But if you're going on holiday and the earnings season was terrible and you're worried, well, this would have more than enough covered the losses that you see on your portfolio of shares, right? So this is really how you can use put warrants. Also because of their ability to magnify gains on the downside if you were indeed right about the negative impact on your portfolio of shares. I just also want to highlight why were we getting out of this put warrant. On the 5th of August, we actually ran a piece talking about how much they had surged just over the past week, and what potentially some investors thinking that it was the index could be undervalued or oversold. Technically, it was looking oversold. So you can cover whenever the support levels come into play and you think the markets will bounce from that. So how can you identify a warrant? Now, warrants are listed on the SGX. So you trade them as you do shares. You go into your Pullman's platform, you basically look for the warrant using what? Using the 4-digit codes here that you can see on the screen. Why? Because if I wanted you to look for the name of the warrant, I think most of you would give up, right? It is looking very long. But actually, it's a really simple way of telling what kind of warrant it is. It always starts with the name of the underlying you're looking at. In this case, if you're interested in HSI, it starts with HSI. If you're interested in DBS, you look for DBS. That's followed by Macquarie's code, MB, Macquarie Bank. We're the only warrant issuer in Singapore, so you don't have to worry or stress about other codes being shown. And then followed by ECW, which at this point, I hope you know, it stands for call put warrant. Call. And then EPW stands for put, okay? And then that's followed by the expiry date, 6-digit code, 6-digit number, year, month, date. Now, the expiry is important because warrants are not like shares. They're not meant to be held for a long time. If you're long-term bullish, you think DBS is going to $50, please buy DBS shares. If you think DBS is going to $40, $42 in the short term, because earnings season is coming, you think that could be the short-term catalyst, new CEO and all that, then you can consider a warrant, but you need to note that they have an expiry date. Expiry dates are not for you to hold the warrant until the expiry date. It's just for you to note the maximum amount of time you have before the warrants either becomes worthless at expiry or it's cash settled to you at expiry. Okay, warrants are not like options. They don't get physically exercised to in return for shares. Meaning, if you were wrong, the warrant just expires worthless. And if you were right, hopefully you have cashed out before expiry. Okay, otherwise we give you the cash settlement amount. Okay, so how do you select a warrant to trade? Actually, it's not complex at all. You don't need to have a chart done on the warrant charts. Please don't ever do that. Why? Because warrants track the underlying. They're a means to an end. You use them so you can magnify your returns or you can protect your portfolio, okay? So really what you need to have is your view on the underlying. Where do you think is the entry and exit level and cut loss levels? Okay, it's a short-term trading product, so it's very important. As a long-term investor, some people think it's okay, I'll just cover my eye, I'll buy it and I'll hold it for 20 years if I don't get it right. But with warrants, you need to know where your exit level is, and if you're wrong, where your cut loss level is, because it has the ability to magnify your returns, correct? But if you're wrong, your losses could also be magnified. So you need to be very disciplined. Okay, you need a holding period. No such thing as I'm just going to buy it and hold it till forever. Also, no such thing as I'm just going to buy and hold it to expiry. This product makes you that 100%, 200, 400% return only if you cash in on it. If you don't cash in on it, it doesn't translate into your 400% returns. Okay, so you need to have your holding period. You need to decide what kind of gearing you're happy with, and mainly, lastly, always buy any financial instrument that's listed on tight spreads is the most cost effective. Putting together these 4 steps, we have a tool that summarizes that for you, and it's very simple to use. It's available at warrants.com.sg. It's called the selector tool. Basically, you go to the drop down, decide what underlying you want, decide whether you're short-term bullish or bearish. If you're short-term, in this case, short-term bullish or bearish, put is being chosen. This user is short-term bearish. Okay, and then with that, you just need to put in your target level where you think the Hang Seng is going. For example, if you think it's going to pull back to 20,000, or if you're a shareholder of Hong Kong stocks or Chinese stocks, and you're worried about a pullback from here, right? It's close to 23,000. You think it could pull back to 20,000, 11% lower from here. What happens? If you use the put warrant in the short term, in 2 weeks' time, you just need to increase the number of weeks here. In a week's time, it's going to grow by anything between 128% to 215%. But in 4 weeks' time, the percentage gains are lower. It grows between 54% to 125%. Why is that? Holding it 4 weeks versus 1 week from now, you get lower returns. Why is that? Anyone? Time decay. Okay, holding cost of a product. If this product gives you gearing, gives you, low capital outlay, what has to give? Now ask yourself that with every financial instrument. In this case, it's the holding cost, and it's known as time decay in the case of options or warrants. Okay, whereby the value of the warrant erodes with time the longer you hold on to it. Which is why I say don't buy a warrant and hold it to expiry. No, buy a warrant and hold it to your profit target taking levels or cut loss levels. Okay. And this is one of the tools you can use, the warrant selector tool. We invented it just to make warrant selection easier for you. You continue to increase the number of weeks to the point where you start to see, lack of geared returns or losses, and that's your maximum holding period, okay? Now, we only have 10 minutes today. Obviously, after this, we'll go into Kahoots for warrants. There's another tool called the calculator, which helps you to estimate what the time decay is. Basically, you keep everything constant and you increase the date, and you notice when the warrant drops by 1 bit. That's the number of days that it would fall by its time decay, okay? Or you can simply move the calendar to very specific dates to roughly estimate what your maximum holding period is. So I tell you not to hold the expiry, but what's my solution? I've got two tools here, the calculator and the selector tool, for you to estimate what your maximum holding period is based on your views on underlying, okay? Finally, I talked about how the capital outlay for warrants can be very low. How do you decide what your investment amount can be? In this case, we always look at the effective gearing levels. Effective gearing levels tell you two things. They tell you, first of all, one, how much the warrant will move indicatively, but for a 1% move in underlying. In this case, this S&P put warrant has got a gearing of 10.9 times. What this means is that if S&P comes off by 1%, this put warrant should go up by around 10.9%. Okay, so this is roughly how you use it, effective gearing. But the other way of using it is to help you to determine the capital outlay. Okay, what kind of investment dollars you're putting. In this case, if you are holding on to $100,000 worth of NVIDIA shares and you are again worried about the short term, or let's just talk about US shares because the elections are coming up, right? So how do you position for a month's time where it's Trump versus Kamala and you're a bit worried about the impact, regardless of who wins? In this case, if you're holding on to $100,000 worth of US shares and you wanted to hedge against the short-term downside, okay, you're a little bit worried about it. How much should you be putting this warrant? You divide it by the gearing levels of 10.9 to get around a $9,000 investment. So ladies and gentlemen, that's $9,000 to hedge your $100,000 worth of US shares. Why? Because if US shares came off by 1% or US S&P index came off by 1%, this will grow 10.9 times more. So you invest 10.9 times less, okay? And then you just divide it by the price of the warrant and you get the number of units that you can be putting into your Poyon system to buy. Just like shares, you look for the warrant code, type in 188,000 units of this warrant and then buy at 4.9 cents. That's how you really transact. Now, I don't have much time left. So just very quickly, how can you find out a bit more about warrants? Well, the website warrants.com.sg. If you haven't gotten enough of me or you think you like me in 1 minute snippets, I'm available there on those videos. We constantly are adding on more videos. We also have the newsletter, which I've showed you why I hope you join, because more than getting a good disposable bag to put your groceries in, we hope to put out news that will benefit you, when investing in the market. And then you can follow us on Telegram as well. We have an ongoing promotion with Phillip, whereby as long as you do one buy trade of a minimum value of $3,000, you get a cash rebate of $88. And then we've also organized an advanced warrant seminar on Tuesday. You can sign up outside. I'll be there again this time to give you an hour presentation on what warrants are, because I think it's important that we get educated before we get started. So hopefully I'll see you there. We have vouchers that we will give out, probably easier to win than a Kahoot game. And we've got dinner provided. So hopefully we'll see you at the Macquarie office. Okay, and with that, I'll come to the end. Thank you very much.
All right, thanks, Jimmy. So now we'll be transiting back to Kahoot again. So like I mentioned just now, get your phones ready or your device that is entering Kahoot. Right. So while we are scanning in this code, all right, just a reminder, the questions this time around we have 10 questions, so a bit more, all right, and some of them might be a bit more difficult, but we will try to speed past them. And hopefully, the lucky 3 winners remember to screenshot, all right, screenshot your winning position, and then either email or look for my colleague outside. The colleague you can look for is actually in this room on my right-hand side. That another beautiful lady over there, all right, long hair, long low owl. Or if you are online, you can send an email to tj_team@phillip.com.sg. Right. And while people are still joining in, I'll just repeat also, if you have forgot just now I mentioned, the Poems 3 app, you have limited to redeem vouchers for the SDR. You can redeem first and decide if you want to trade on SDR so that you will get the cash credit if you do trade on it later. And it will be $15 for $500 trade and $50 for $5,000 trade. And it's free, but it's a limited vouchers to redeem. All right. And from what I understand, it's already running quite low. And if you have not yet taken this flyer from the SDR booth, they have shown you the steps on how to redeem the vouchers. If you don't have this paper, you can look for them outside in the SDR booth. All right, I think this time round, we will be able to start in 5 seconds. I think we're plateauing nearer to 200. Right, so 3 out of 200. Right, okay, 3, 2, 1, let's start. Question 1. Normally we start easier, but long question. So get ready. Question 1. What is the warrant code of this Citroen warrant? Warrant code 4 letters. The answer very clear. I say 4 letters. If you click wrong too fast, I'm sorry. But if you click before I said the answer, then I'm sorry. But yeah, 4 letters. Warrant code. Always search the warrant by the code. If you're not sure of the code, go to warrants.com.sg. Search for the counter underlying that you want. Search for the one that you want to trade, the correct leverage ratio, the correct expiry date, then you choose. Oh, a lot of people choose before I say the answer. The first one is the ECW call and then the expiry date, not the code. Okay, next question. Question 1 very early on. Don't see ranking first. Next. Question 2. Which tool on the warrants.com.sg helps to estimate the future prices and refine selection based on target price and holding period? Help to refine selection base. This one I say the answer you don't know, then also I'm not sure if you can listen to me. Refine the selection based. Live metrics, warrant selector, top winners loser, or warrant search. 3, 2, 1. Warrant selector, right? Selection based. Question 3. According to what Jamie shared, how can you estimate your warrant investment amount? Effective gearing rate level minus spot price underlying stock or volatility. She say your portfolio value divided by the leverage ratio. What is the leverage ratio? Is the effective gearing level. Then you get your warrant investment amount. So you divide by the effective gearing level. Wow, very explicit this time. I want all you all here to win. Just now only got 1 winner. Not happy. 2 winners at least from in the room. Effective gearing level. Okay. More people waiting for my answer now. Very good. At least get correct. Got chance already. What logo is used to mark out the trending focus warrant? She didn't have time. But what is the trending focus warrant? What logo do you think? Water, fire, tick, or group? Trending. Very on. We say something is on what when you are trending? On what? On record. Very hot. On fire. 11 seconds more if you haven't chosen yet. If you're waiting for my answer, on fire. I think you will never know. You answer correctly. See, you answer correctly, you are at least in the top 129. Very good chance still. Okay, next. Question 5. What tool shows you how the warrant prices move alongside with the underlying stock? No time to share this though, but it's always a sharing how it moves between the stock price and the thing is always a matrix. Then the answer very clear. Just find where the matrix word is. How fast you find the matrix word is how fast you answer. Right? Because you want to see the price difference between warrant prices and the underlying real time. Right? So you say matrix of number. If you are a max person, you will know what I mean. If you forgot your max, never mind. I see the answer already. You still get correct. 131. Got the people too urgent. They answer before I see the answer. Next question. Question 6. Select the correct market making hours. One very hard. But think of Singapore trading hours. You need some buffer before and end. Don't end on the dot. What is the market making hours? Singapore trading hours, but some buffer at the end. And will be the determining one. I never see answer, but very close to answer already. Who will get correct? I think 90 people only. I guess 90 people. Yeah, very close. 82. Top 82 got correct. Ranking confirm change. Question 7. We will start seeing the ranking at question 8 and 9. What does a 241227 mean? 2024. What month? What day? 2024. What month? What day? Is it the expiry date or is it the last trading date? Last trading date is 5 days before expiry date. It is relevant. This 5 days before expiry date is relevant to you to remember. If you hear me right now, you don't hear me, then too bad already. I will only say now. Expiry date, last trading date. Okay? Next, when is the last trading day of a warrant? Last trading day, don't know. 1 day before, 3 days before, 5 days before, 7 days before. I now give answer. I don't know whose answer. Just now I said something. No one got here or not. Never hear my answer. I said 5 days before at the previous question. Okay, let's see the ranking first. Don't click so fast. My colleague too urgent already. Question 9, later we see ranking. What is the effective gearing range? Effective gearing range. Approximately something not so whole number one. Not so whole number one. Not 1 time, not 30 times too much. Not a whole number. Also a difficult question. Wow, but everyone get correct. I said not whole number, everyone get correct. Everyone still trust in me. Let's see this ranking first. AJYLKHRT. Anyone here? I hope there's someone here. Let's go to the last question. Do screenshot if you win. Why do the investor trade? Singapore answer, standard. What is the answer? Singapore like to do this one. Why do we use the ABC but actually got a D, all the above? Then you choose something. We always like to do this. Singapore, favorite. We want check it out. Everything eat. Again, everything we want. We want good, we want cheap, we want to have the answer. All the above. Right? If you are the top 3, remember to screenshot, contact my colleague, or send to the email. Let's see the ranking. Next, please. Top 3, podium. Third place. 9 out of 8 correct. 9 out of 10 correct. RT, AJY, and LKH. I think AJ1 was the same person and LKH. Who's familiar? The name, I think I saw the names before. Anyone here in this room? 1, 2, wow, both together. You all two very fast, buddy action. You all are not RT. Okay, so RT missing. RT is there. Okay, RT. So all three winners in this room, in the Audi. Congratulations. We'll move to the third one. We also have another Kahoot there, and then lucky draw, and then lunch. So this handsome fund manager, Mr. Charles Lee, is between you and lunch. So you pay attention, he will be faster, he will let you go for Kahoot, lucky draw, and lunch. Okay, let's welcome him.
Good afternoon. So I was told I was given 10 minutes, so I'll just brief it through quite quickly. But I just want to give you more updates on what is happening in the market for the REITs market. And I believe everyone in this room has a decent exposure to the Singapore REIT markets. Before I start, let me go through 2 slides because I was told to go through these 2 slides for the introductions. Just do it quick. PCM incorporated in 1999. We are the fund management arm of the PhillipCapital group. We manage about closing to about USD 38 billion in assets to date. Okay, sorry. So we have a network of office across the region. London all the way to Australia, and regionally, I think we are still very exposure to the regional market. And these are our flagship products. You can see on the right-hand side, we have the ETFs. We have grown up over the years. We started as active managers, unit trust itself. And basically, if you look through the whole product range, I think we are very yield focused. All right. So, okay, let me give you an update. The REITs market has actually recovered to a certain aspect since over the past 2 months itself. As if you look back last year itself, during the October period, it's quite similar to the October period last year itself. What we have actually noticed is that actually the difference is actually last year we were still expecting the Fed fund rates to be cut. That's why you can see. I mean, last year the beginning of this year itself, there was a bit of choppiness. But overall, if you look at the REITs market, if you are investing in REITs, it's actually doing much better versus the property markets and versus the STI market itself. Well, if you look at the STI markets for over the past 3 years, when interest rate was actually spiking itself, the banks are actually doing much better because of the interest rate margin has improved the bank's earnings itself. But moving forward, on the flip side, the REITs wasn't doing well because interest rate is more like an expense to most of the REITs itself. So they got a bit of the hit over the past 3 years. Moving forward, the rates has cut in September this year. The Fed fund rates cut by about 50 basis points itself. So we will expect a relief for most of the REITs operators in Singapore itself. And I believe most of us, when we invest in REITs, we are always looking at the so-called the yield, the collection of the yield itself. But yield is always a function of both 2 items, which is the price of the REITs, also the underlying DPUs that the operators pay out. I'll touch on both of them subsequently. If you look at this chart itself, I showcase 3 items, which is the 10 years government bond, MASB, and the white color is actually the share price of the REITs market itself. You can see the REITs market is actually has recovered. It's a U-shaped recovery beginning of this year to now itself. the government bond yield is actually more like an indicator for most of us to keep track. Bond yield comes down, most probably people will buy into REITs because the yield spread will improve in that aspect itself. But somehow, I think the market is moving a bit far ahead of time itself. That's why you can see in the latest slide, actually the spread didn't improve, but more or less it has actually tightened in that sense itself. Market players is always forward-looking in the sense that they are expecting fundamentals to improve itself, which means the DPUs to be paid out gradually more and more as time goes itself. So if you look at this, the yield spread between the risk-free rate and the yield of the REIT itself, the blue line is actually more or less the yield spread mean itself. But now the yield spread is actually touching the one standard deviation rate line itself, which means in some ways it's not attractive at this point of time in the aspect itself when because of the market has more or less pricing has moved too fast. On the year to date, sorry, the past 2 months itself, the REITs actually has improved by about 15% compared to the similar situation last year. Before the corrections in January itself, the REITs also has gone up about 18%. So more or less, I think in the short term, what we feel is that there'll be a bit of correction in the market. And also something to take note is actually the yield, the blue line itself. You can see actually the blue line is so-called rebound. I mean, taking up again, the blue line is actually also follows the US 10 years Treasury, also the expectation of inflations over time. And if you look across the globe itself, a lot of things is actually so-called supporting the inflations in the US, not to mention the oil price coming back, driven by the Middle East tension itself. If you look at the STI versus the yield between the STI, yes, I mean, traditionally you can see that S-REIT actually has a better yield than STI itself until recent times, which I mentioned, the bank has actually pay out more yield. Of course, when with the expectation of interest rate to come down lower, we will see this actually to widen over time, over the next few years. So it makes your investment in REITs looks much better. But of course, we have to look back and understand the fundamentals at this point of time. If you track the half-yearly results reported itself, majority of the, I mean, most of the REITs is actually still facing higher interest rate expenditure itself. So this is actually a very key concern at this point of time. But we'll hope that this will improve as over the next few quarters when all these REITs operators starts to redo their refinancing. So that's why the next thing that we have to look at is actually the debt expiry for next year itself for most of the REITs itself. Those who have a bigger debt expiry, they'll tend to enjoy ease of the debt management pressure moving forward. So of course, with a bigger financing expenses itself, your REITs will not be able to pay you as much as previous years itself. So you can see actually the DPU is still declining. So this is actually the second part which I mentioned of the function of the yield itself. I mean, your share price goes up, your DPU still continue to come down. That's why you can see actually the yield spread between the 10 years risk-free rate and the yield spread actually has narrowed itself. So that is also something that we have to be a bit cautious. But on the whole, what we feel is actually with the cut of the interest rate, we should have a bit of ease in our investments in REITs moving forward. Touching on of course, that's on the debt financing part of things itself. Of course, if you look at the different segments itself, if you drill down into the retail side of things, We are still comfortable on the retail because of the supply in the retail space is actually still very well maintained in the aspect itself. Singapore retail subsectors will see an average about 0.4 mil coming online for the next 3 years. This will be quite well supported by the demand. So unlike other countries, you can see they are quite depends on the market itself. I mean, there's no control on the government level itself. So, Singapore, as you know, we have very limited space. So you can see the retail is quite, the supply is quite well maintained. Prime rates is actually doing much better compared to the suburban rates itself, which is the heartland malls itself. Most of the time, prime rates actually will do better because of the tenants. They are more so-called upmarket tenants itself. They are more willing to spend. So demand for the kind of space they'll pay so-called a premium as compared to the suburban malls itself. Of course, suburban malls tends to be a bit more heartland, and retailers also have to depends on the so-called the sales. A lot of the REITs operators, the retail REIT operators actually has showcased tenant sales has improved to almost about pre-COVID levels or even better than pre-COVID level. This is also something that we are also a bit skeptical at this point of time, because that also has a buff. I mean, that's also have the inclusion of the inflation. If you look at the footfall traffic, it has not yet recovered back to the pre-COVID level itself. Something forward to look at is the and all these are public information. You can look at the Singapore MTI website itself. As the most recent reporting on the retail sales, you can see retail sales is actually coming down. Departmental stores, cosmetic, toiletries, and these are the things that you also can see being displayed in your heartland malls as well as your downtown malls also. So you can see actually the inflation is also starting to kick in that sense itself. But so this is also, but some point of time, I think the government also helps to alleviate all this pain. You can see, I mean, with all your CDC vouchers, with all your utility bills, and this also helps to improve consumer spending. But something to take note is also the wage level in Singapore also has also crept up quite a fair bit itself. So this also helps to alleviate all this kind of sales. You can see that consumers in Singapore they are pretty more reserved when it comes to spending at this point of time. Hotel rooms in Singapore is also quite well maintained. On the supply side, I think on average, I think you can see a 1.6% year-on-year growth for the next 3 years until 2026 itself. This is on the supply side, something that we are quite comfortable at this point of time. But of course, you look at the demand side. Demand side is always the tourist arrival itself. Good to know that the Singapore Tourism Board is targeting about 15 to 18 million this year itself. Based on the current date, which is August itself, we are doing about 11.3 million tourist arrival itself. If you project maybe further down towards the end of the year, I think we should make the mark of about 17 million. China tourists has actually accounted for about 55%. And this 55% is actually quite in line with the pre-COVID level itself. But if you look at on the whole, we are still below the pre-COVID level itself. Beginning of the year, you can see the hypes of a lot of the concerts itself has also created the kind of the room rates for a lot of the hotel operators itself. Yeah, but in recent time, I mean, most of the REITs operators like CDL, FEHT, and even like Fraser Hospitality Trust also has reported a weaker second quarter revenue itself. But on the whole, we are still comfortable with this. I guess the STB will always, because given Singapore as a hub, I mean, it has always improved itself to bring all the minds and events itself. So we are not quite concerned on this. For land sales, this year actually has marked up quite a fair bit as compared to last year itself. First half of this year, you can see Singapore's government actually has increased the land sales of about 8.2, 8.3 hectares itself as compared to 3.3, 4 hectares last year. So it's almost double. Second half of this year, actually, it has mellowed down to about 5.7, 5.8. On the whole, we're still seeing a 57 year-on-year increase in the land sales. So when you see industrial land sales increasing itself, you also impact our industrial exposure for the REITs operators in Singapore. Names like ESR, names like AA, AIMS REITs itself. So they have a heavier exposure to the Singapore industrial space in Singapore. But one of the segment of the so-called industrial we really like is actually the data infrastructure access itself. So data infrastructure access has recovered, has done better than the general REITs market during the during the interest rate hike period itself. They are the heaviest to get whacked in that sense. This year, I think they have recovered quite a fair bit. But if you look at the different segments of the data names, KDC actually has improved given the fact that the China assets has more or less resolved to a certain extent. Then the other two assets, which is the Mint, which is the Mapletree Industrials, and the DC Core itself. The two of them actually has a heavier exposure to the US data center infrastructure itself. For that particular exposure, they are actually quite subjected to a very big supply in the space they're operating. So that's why you can see the share price actually not doing as well as the KDC. KDC, most of the assets is actually in Singapore. So history actually has shown the REITs will do better when interest rate cuts itself. If you look back 2018 itself, when interest rate was cut by the Fed fund rate itself, 2019, I think REITs was doing about 20% upside itself. So we will expect, I think next year we'll see better improvement expectation of the REITs markets. That's keeping our fingers crossed, like in the sense that the yield will not spike up as what, given the kind of scenario we are facing moving forward in that sense. Another regulatory tailwind which is good to have. Recently, the government also has come out to say that, let's shift all the 45 leverage ratios to 50 percentage point itself. But of course, they also has given the conditions that all the interest coverage must be at least 1.5. And this is good to have, but I don't see it as a very big impact in that sense. But of course, given the kind of scenario that we are moving for now, the lower interest rate environment, you can see more M&A activities coming along the way. You can see the CICT also has reported they're going to buy up Iron Orchard. Escort also has started to announce that they are buying up the lift of this Funan assets itself. So you can see, I think to date, I think we'll see much more activities compared to last year. I think next year we'll see more of these activities coming along with landlords trying to monetize most of a lot of the assets, given the lower interest rate environment. Yep. Sorry, just the last slide. Key risks will be on the Fed fund rates. Cuts will not be up to expectation because of the inflation and the Singapore domestic consumption's impact by inflation. Not so big of a concern, but this is also still a very key risk itself. Sing dollar strengthening will also impact tourist arrivals. The bandwidth of the nominal interest rate exchange rate is still at a very high. We're still waiting for the next meeting, which is this month itself, to see whether the government will shift the band downwards a bit because of the expectation of interest rate also has come down quite a fair bit compared to the beginning of the year itself. So geopolitical tension has always been a big concern year on year itself. But this does not impact, and possible swarm event CRE blow up, not so big, but still a very hidden risk that everyone is just keeping a lookout for. All right, thank you.
All right, thanks, Charles, for the sharing. I think all of them are interested in that because it's the REITs sector, which is one of the main sector benefiting from the interest rate cut. While my colleagues shift over to the Kahoot slides, I also like to thank everyone that you have been here so patient with us. And actually, hope you have enjoyed the session. So I think same practice, you have already tried it twice, this is the third time. Hopefully, this is the third time perfect for you if you're not won yet. Right, $1, 3 tries, then only $1. You come in here, free, 3 tries. All right. Very fast, see, everyone joining in very fast. Okay, so same thing, reminder, not only to screenshot if you win, but now I want all of you to, after you join in already, while waiting for me to start, ensure you still have your flyer with you. If you do not have flyer with you, you are not participating in the lucky draw prize. And some of you, if you have been wondering what is the lucky draw prize, I have not mentioned a lot on it. Look to my left, the very far end. 3 things for you. One is traveling for you, right? Cabin luggage, third prize. Okay, so anyone traveling, 1 new luggage can aim. Second prize, don't know if you all use it, but you all can use wireless earbud from Samsung. Not a Tapalang brand, real brand, Samsung brand. First prize, Samsung Galaxy A9 Tab 256 with LTE. Can connect internet, can connect data. But of course, you must buy your own SIM card. We don't provide SIM card. Only the tablet. SIM card you buy. No SIM card, you use Wi-Fi. Also can use, no issues. Okay, I think we are almost there. Last 5 seconds to join in. Those online, I want to thank all of you all for joining in and staying with us for so long as well. I hope you also have a chance to win. However, sadly to say, the online audience will not be participating in the lucky draw. So, for the next one, I don't know if we confirm a lucky draw, but do join us at a physical event. We have limited tickets, first come, first serve. Do join us here physically, and you have the chance to win the lucky draw for the next session. For next year, 2025, still a full year ahead. Very exciting year with all the excitement in volatility in markets right now. Okay, last 3 seconds before we start. Get ready to start. 2, 1. Yes, please help me start. This one, 7 questions, if I never remember wrongly. 7 questions from the PhillipCapital management. This one, I will not give a lot of hint. There's only 2 answers, A and B only. Did S-REIT outperform STI over the past 20 years? Yes or no? 2 parts. See, Philip one, very simple, straightforward. Left, right only. No need 4 options. Don't need scared click wrong. Left and right only. You choose wrong, also open. You never listen to him just now. So now Charles got share. Right? Charles definitely got share in the first few slides. Right? Yes. Okay, some 30 people sleeping. Next question. Question 2 out of 7. What is the relationship between S-REIT and the Singapore 10-year bond yield? Is it inverse or correlated? What is the relationship between S-REIT price performance with the bond yield? Last 5 seconds. You 50-50, so better than just now, 25%. Oh, now 62% get wrong, double of just now. 131. Does the Fed rate cut benefit S-REIT? Yes or no? Now yes, right side. Don't click wrong. Yes, right side. No, left side already. Yes or no? Benefit? Yes or no? So now yes was left side. See, you click on, you switch around. Don't click same side. Only 2 answers, but we don't keep same side. Look carefully, then press. Oh, then see our questions, all very fast answer. Yes, 155. Back to normal. 35 wrong. 30 plus wrong. Question 4. Which S-REIT achieved positive DPU growth in first half? Parkway or Fraser Hospitality Trust? Parkway Life Real Estate or Fraser Hospitality Trust? Positive DPU growth. I think just now even the Darren, our research team managed to share on this as well. Oh, half, really. Everyone to come. Everyone do not answer. I now give answer. Everyone don't know. Half, Parkway Life. Correct. AKH again. AKH. Very powerful. What percentage of earnings must an S-REIT manager distribute as dividend? Less than or more than 90%? The S-REIT need to get the tax benefit. They need to distribute more than something percent. So more than 32, answer too fast. Never hear my answer. Okay, next, slowly. Don't press first. So let me see. Okay, AKH still first. RT also similar. And 10. I hope I see new names. So those haven't yet close one, please try. Next question. Last two questions. How much leverage can a REIT manager take on? 90% or 45? The answer was mentioned towards the end of Charles' presentation. They're looking to change it, but it's currently still at what ratio? 45. If reached 90%, I think very scary. Yeah. Next question. Oh, really got change person. WK. Okay, hopefully we have a change of people. Next, last question. Is the Phillip Singapore Real Estate Income Fund passively or actively managed? Phillip Singapore Real Estate Income Fund. Fund, not. You got trade on, you know. You trade UT, you trade ETF, you know what this title means. Fund. If it's a ETF, it's called exchange traded fund. Yeah, it's called income fund only. So actively managed. Okay. Podium. Please raise your hand if you are the top three. RT, you win again. Congratulations. WK. Oh, congratulations. I saw you tried a few just now. Finally, you win. Congratulations. AKH. Congratulations. All right. So we have the three winners all here also. So my colleague will take note. Now, we are going towards the more exciting one. But before we go there, there's advertisement time.